bit of a struggle for direction. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. with about 2 hours to go. You take a look at the equity market right now, and it's on the back foot. We got some maybe hawkish comments from Chris Waller a little bit earlier today. It's definitely taking the steam out of the stock market. The S&P 500 currently off to the tune of 0.6%. You take a look at big tech, the NASDAQ 100 currently down about 0.4%. All the action is in the bond market. The 10-year Treasury yield currently up about 13 to 14 basis points. We are well above 4%. We'll see how long we can actually stay there. And meanwhile, take a look at Bitcoin. It turned into a bit of a sell the news moment last week when we finally got the launch of those spot Bitcoin ETFs, Romaine, but currently Bitcoin fighting back into the green.
Yeah, we'll get back to that story in just a little bit, but let's start off with earnings, a tale of two earnings, if you will, for two of the most storied banks on the street. Goldman Sachs rallying just a bit here after its equities trading unit posted a big jump in revenue last quarter that was triple what analysts had expected. Now, that helped to make up for some serious softness still in that deal-making business, and it actually provided a rare victory lap for CEO David Solomon, who, of course, spent most of last year getting battered around by criticism. Meanwhile, Morgan Stanley's incoming CEO probably a bit uncomfortable with what he's seen, the bank's shares dropping the most in 3 months as its traders fell short of expectations, and that company said lower wealth management earnings could actually be a big deal this year. We're going to get back to both of those stories in a minute. But I do want to focus for 1 second here on bond yields. Katie just mentioned they're rising today, and that is largely on speculation that bets on as many as half a dozen Fed rate cuts this year are likely a bridge gone too far. Activity most pronounced on the longer end of the Treasury curve, with 10 and 30-year yields rising the most since early November. Fed Governor Christopher Waller chipping away at that rate cut optimism, saying that, yes, the FOMC could be in a position this year to loosen policy, but with economic activity and labor markets in good shape, no reason at all to move as quickly or cut as rapidly as in the past, he said. And while investors have tried to focus their attention solely on corporate earnings, Morgan Stanley strategist Mike Wilson says, sorry, Charlie, or maybe sorry, Katie, but interest rates are still going to be the most important determinant of equity index direction.
No need to apologize to me, because you take a look at the stock or the chart I have behind me, you can see in the blue line that relationship between stocks and bonds, when that blue line, the 2-year Treasury yield, falls typically as of late, looking at the correlations, that has meant that the equity market sees a tick higher. The S&P 500 actually rallies when you see the 2-year yield drop. So you can have this twin stock and bond rally, and you've seen that materialize over the past few trading sessions. And that, of course, gets back to what's priced in when it comes to the Fed cutting cycle. If you take a look at what's priced in right now, you have more than 6 quarter-point rate cuts priced in to 2024. Of course, what actually makes that materialize is an open question, whether that's just normalization, getting back to neutral territory, or whether that's going to take a recession, Romaine, remains to be seen.
Yeah, absolutely. Here, let's get some fresh insights out of Remy Olupatan. She's the head of multi-asset growth and income over at Schroeder Investment Management. And I do want to start there, Remy, here with the moves that we're seeing in the yield space, and maybe the idea here that the Fed, as they continue to push back on this idea of a multitude, a plethora, if you will, of rate cuts this year, is there a case to be made here that maybe the market should now start to repivot, just, I guess, temper expectations just a little bit?
Oh, absolutely. I think the market has rushed into expecting quite aggressive rate cuts, and the timing is a little early. So to some extent, the market is in a hurry, whereas the economy and the Fed are not in as much of a hurry. So there's a little bit of a reality check that's happening. We expect that to continue. We certainly think March rate cuts are far too early, and we think that that needs to be priced out. So that's going to cause a little bit of volatility over the next couple of weeks.
When you look at some of the moves, at least for today here, it's big moves pretty much across the entire curve. But the biggest moves are on the longer end of the curve, the part of the curve that maybe is a little less sensitive to that sort of month-to-month changes in the Fed funds rate. What is being priced in there? Is that still about the Fed, or is that more about Treasury supply or economic conditions?
Absolutely, it's all of that. Definitely Treasury supply, because we do still have a big deficit and more supply is needed. And as we start to think about the US elections, I know they are still a fair bit away, but we do have to start bearing that in mind. That also comes into play in terms of what that means in terms of more supply as we move through this year and next year. So a lot of investors are having to put that into play. And as we talk about inflation, yes, inflation is coming down, but actually we are being told that rates will remain rather restrictive. So although the Fed wants to cut rate, their intention is to maintain rather restrictive policy. So that needs to be reflected in longer dated bonds.
And let's talk about the relationship between the bond market and other asset classes, because I'm going through your notes, and this line I thought was pretty interesting. You take a look at falling real yields, and in your view, the fact that they're falling, that's helped you establish an overweight position in gold. Talk us through why that makes sense, why falling real yields will benefit gold here.
Yes, absolutely. I mean, gold is one of those unique assets that there is no carry, no income. So there is an opportunity cost. So if the opportunity cost, which is real yield, starts to decline, it makes owning an asset that doesn't pay any carry more attractive. It makes it shine a lot more. And that's what we think will happen this year. Certainly, real yields need to come down. Again, they're not falling as quickly as everyone would expect. But in our view, the direction is what matters. And the direction is lower real yield. So that will enable gold to shine this year.
And falling real yields, you think about the fact that maybe the market is over-egging just how quickly the Fed will cut rates. But where does that leave you on emerging markets globally?
That's a challenge, because right now, when everyone refers to this term of US soft landing, it doesn't necessarily include emerging markets and the rest of the world. I think, unfortunately, with emerging markets, certainly in Asia, we are expecting a slowdown, a more meaningful decline in growth. So that is a headwind in terms of taking advantage of those assets. And the outlook for the dollar also matters. So with real yields falling, but falling very slowly, that makes it difficult for the dollar to decline. And that is a challenge for emerging market assets. So the currency really matters.
Remy, always great to talk to you. Remy Olupitan helping us kick off to the close here, head of multi-asset growth and income over at Schroeder Investment Management. Coming up here on the program, a deeper dive into the results that we got out of Goldman Sachs and Morgan Stanley, a breakdown of the numbers with David Conrad over at KBW.
Plus, the second commercial ship was struck by a missile in the Red Sea in the space of 24 hours. More on the rising tensions disrupting world trade. And artificial intelligence, a major topic of discussion out in Davos this week. We're going to have highlights from our interviews with OpenAI's Sam Altman, Microsoft's Satya Nadella, and Alphabet's Ruth Porat. All that and more coming up in just a bit, right here on The Close. This is Bloomberg.
This week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As markets anticipate a dovish pivot by central banks, policymakers grapple with two wars on the global stage, and AI continues to dominate the tech headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Continuing coverage this week, only on Bloomberg Television and Radio.
Bank stocks on the move today. Goldman Sachs and Morgan Stanley shares diverging despite a pair of better than expected results. Bloomberg's Catherine Doherty joins us now for more. And let's start with Goldman, because shares were down and then they were much higher and now they're pretty much back to flat. What's going on here?
So the results were kind of a mixed bag. I'll start with trading. Equity traders at Goldman exceeded expectation while fixed income missed estimates. And that's very similar to what we saw at Bank of America last week and Morgan Stanley also, about in line with those results. But across the way, in asset management and other of their wealth management operations, those results came in higher than expected. So I think that's why you're seeing a little bit of swings First, the market was reacting negatively to those results. Then that came back a little bit. So now we're starting to parse through. We've gone through the analyst calls, and really what was coming out from those sentiments from Solomon, for example, on the call today was optimism. So if you talk about the end of the year and how things wrapped up, they're really seeing some green shoots and some positive momentum that would build into what may signal for a better 2024.
Where is he seeing that? I was actually surprised at his optimism, particularly given some of the missteps that we saw in some of the other businesses and the idea that trading, while that's great that they got that big boost here, we know how fickle that can be on a quarter-to-quarter basis.
So across Wall Street, not just at Goldman, but debt underwriting was a lot higher than expected and higher than equity underwriting. This is not surprising in an environment like we see today, where the expectation is for rates to cut back, but not until later next year. There's still some uncertainty. So deals are starting to come back, not in a very meaningful way. What we did here today is that executives are expecting that will switch later in 2024, but that they're already starting to see signs of that switch. And it's because of what they say, optimism, the confidence that is building with investors as they're able to model in, price in some of the expectations for the new year. And that is really what's going to be the pivot point for deals. Their executives seem to have called now being the bottom, and that they expect things will get better from here.
And it was interesting to hear you use the phrase mixed bag to describe Goldman's results, because it feels like this entire earnings season for the big banks has been kind of a mixed bag with several of the biggies under our belt. I mean, where do we stand right now?
Well, Citi was an outlier. They are undertaking some significant reworking and cost-cutting measures. That includes 20,000 roles that they're going to look to cut in the coming weeks, months. So that's something that is a little bit of an outlier to the other banks. But again, despite that kind of negative stance that Citi is taking, we heard Fraser talk about the opportunity in 2024 and ahead to have this be a positive pivot point. A lot of people are using those types of words as, all right, here we are today, but we really see momentum building, and we're going to use this as kind of a catalyst for positive growth in the months and the quarters ahead.
Catherine Doherty helps lead our coverage here. Two of the big Wall Street banks helping to round out the start of earnings season. Let's continue the conversation right now with David Conrad. He's analyst of large cap U.S. bank equity research over at KBW. KBW, a Stifel company. Great to see you back on the program here, David. We had three big ones today. Of course, Morgan Stanley, Goldman Sachs, and you can throw PNC in there. Which one was the biggest surprise to you?
I think they all kind of came in as expected. You know, PNC's numbers were certainly a little bit more visible. I thought the outlook was a tad weaker than expectations, but given earnings season, that was pretty much in line. I thought Goldman had a better quarter than Morgan. Both very noisy, but I think why the stock's reacting better is kind of further along the restructuring story, meaning that there is an acceleration decline in riskier private equity assets on the balance sheet. And then you could see, after the first quarter, they're going to be the majority of the way through the consumer restructuring.
What exactly do you think Solomon is trying to do in terms of how he's trying to position Goldman? There's been a lot of speculation about some of the moves that he made over the last year and a half, some of the executive departures, which may or may not have been voluntary. What is he trying to build here?
Well, I think, use the word pivot again. I think the consumer initiative was clearly a mistake. I do give him high marks for effectively admitting that, right? And shifting course, after 2 years. And I think where they're going to go is a little bit back to the roots to some extent with capital markets, investment banking, trading. But asset management is becoming a bigger and bigger part of the business. And that's where they're seeing the most momentum.
And do you think that will bear fruit on a reasonable time frame? I mean, Goldman Sachs, of course, the stock itself has been lagging some of its peers. When do we start to see the catch up?
Well, I think we'll see a little bit in the back half of the year because the platform solutions will be a lot more visible and more profitable as it shrinks effectively, right? They won't have this big provision headwind that they've had in prior years. And then I think the big thing is again reducing these assets on the balance sheet not only reduces the risk, but that improves the profit margin. And so they're guiding to a mid-20s pre-tax profit margin for asset management. And when that becomes more visible, that's when the stock will really react.
And David, like you said, Goldman probably had a better quarter than Morgan Stanley, but you take a look at the market reaction to Morgan Stanley. Shares are down 5.3%. That is on track to be its worst day since October. Was it that bad to justify that reaction?
I don't think so. The quarter itself was actually better than expected. They actually hit all the key marks. Net new asset growth and wealth management was in line with expectations, and net interest income actually beat expectations. So on the revenue side, it was a solid quarter. The issue is they pulled back on near-term guidance, right? And so really wealth management is what separates Morgan Stanley from its peers, and that's also what investors are really focused on. And I think although they thought the 30% pre-tax margin was achievable longer term, they pulled back the interim period to more 20s pre-tax margin, and that's when you saw the stock kind of roll over with those comments.
I am curious. Let's go just real quickly down the ladder here. We only have about a minute and a half left here. I was curious about some of the results we got out of PNC, and I know they kind of get lumped in last year, about a year ago, when we had the big SVB collapse back in March. And I know they're kind of an outlier in that space here, but are we looking at, I guess, a healthier landscape right now for some of those mid-sized and small-sized banks?
I think when we look at the banks, what's really challenging this quarter is in the fourth quarter, we had a big rally relief with long-term rates coming down 100 basis points. And so that alleviated some capital concerns and improved the balance sheet valuation. Now, as we look forward, there's a lot of uncertainty on the revenue side, and it really gets into your point you were discussing earlier in the program. Is the forward curve right? Is the dot plots right? For us, if the dot plots are right and not the forward curve, that does set up a really good backdrop for the super regional banks.
All right, David, great to get some time with you on this busy day. That is David Conrad of KBW, a Stifel company. And Romaine, again, you take a look at the shares, not too dazzling a performance from the big banks. Yeah, not too dazzling. I mean, some of this was front run, we should point out. I am curious, too, just about the juxtaposition between whatever Solomon's doing over at Goldman. And, of course, now you have a Morgan Stanley, which, of course, has an outgoing CEO and a new CEO. Ted Pick will be coming in following a quarter that, was less than stellar here. Mm-hmm. It kind of makes you wonder where they're going to pivot. We know Morgan Stanley leaned a long time ago into that wealth management side. That necessarily hasn't been the ballast for some of the other banks. Yeah, we'll see Goldman's ambitions in the space, and also in a league of her own, Jane Fraser from Citigroup. You think about restructuring, and she's really pursuing that quite aggressively. And it's interesting, too, when she first started that, there were a lot of people kind of saying that, okay, is she being a little too heavy-handed with this? And now, with the benefit of hindsight, looks like she knew a lot more than the rest of us, right? Yeah, it'll be interesting to see what more is coming, if anything. But next up on the close, we have tensions in the Red Sea escalating after a second commercial ship was struck by a missile. We'll have the latest details next. This is The Close on Bloomberg.
It can go higher. The U.S. is blessed with an abundant resource base. Traditionally, when risks elevate in the Middle East, you see it reflected in markets. We've not really seen that yet, and so I'm a little surprised. All right, Mike Wirth there, the CEO of Chevron, out in Davos discussing the rising risk in the Red Sea and the impact on oil prices here. And we should point out that his comments came after we learned about a second commercial ship that was struck by a missile in the space of just about 24 hours. We've already heard from Shell, which has halted oil tanker transits through the waterway. And other shippers here are really having to make some hard decisions about whether they continue that Red Sea route or try to find longer and, of course, more costlier routes. Julia Fanzera is joining us right now to talk a little bit more about what's going on here. And let's talk about that. I think it's interesting, like, who's making the decision to go through the Red Sea and who's making the decision to go around it. Is there any rhyme or reason into how those decisions are being made?
As the CEO of Chevron said, obviously they're making big decisions that we don't know about, and that's a little bit above our pay grade. But I think what's interesting is the fact that we don't see that risk premium in the markets right now. And a lot of traders that I've been talking to have been surprised. But what they're saying is insurance costs are higher, but we're not seeing crude fundamentally being pulled off the market. It's just being rerouted and taking a little longer.
So no risk premium in the actual price of the crude itself, though higher insurance costs to get it shipped.
Very minimal risk premium, $2 to $3 is what I've been hearing.
And it's interesting. I mean, you heard from the Chevron CEO, Mike Wirth, that he was surprised that there hasn't been more of a risk premium built into crude. You really haven't seen it all too much. What's the dominant story there? Is that just still supply? Is it weak demand or some kind of combination?
Traders are saying that they have been burned in the past by making the geopolitical trade and that they're not going to do it until they see those supplies pulled out of the market. And even this morning, we saw that Russian supplies have actually been making their way to the market. So fundamentally, it's still a little bit of a bearish story, and traders are waiting to see, well, are these crude shipments going to be pulled out of the Red Sea? Because in that case, that's something completely different.
There's a question, too, as to if this had happened when the demand picture was maybe a little bit more solid, would we be talking about a much higher premium?
Absolutely. And I think some people are still surprised that we aren't seeing a much higher premium. We just keep seeing, as you mentioned, escalations, more attacks on merchant ships. So it is still surprising.
I'm curious, how much credence is there to this idea that the Houthis, and I know you may not know the answer, but the Houthis are specifically targeting ships that, at least in their view, somehow have links to Israel. Either they're going to Israel or they have cargoes that in the past have gone to Israel. There's been a lot of anecdotal evidence that some Chinese flag ships and other ships that don't have the same relationship with Israel are somehow being left alone.
I think that's definitely a possibility for sure. And I think that is why we are seeing such focus being turned to this, and because it could easily turn into a proxy war, especially allies of Israel like the US and the UK.
And just really quickly, let's talk about the weather, because I'm looking at your latest and you talk about oil swinging, the price movements that we're seeing. Of course, it feels like everywhere in the U.S. except maybe Florida is very, very cold right now. How is that affecting oil?
What's surprising is that the fundamental weather picture is actually impacting oil more than these geopolitical factors, because North Dakota, one of the second biggest shale basins in the U.S., is actually out, and that's 650,000 barrels a day, and that's really impacting prices. But again, traders said, well, we're going to wait to see how this materializes, and prices are going to close back down around 1% today.
It's out, what, just because of the weather is too cold out
just
there?
because it's
I thought they would be used to
too cold.
Even too cold for even North Dakota.
Too cold for even North Dakota.
I sympathize with that. I know that
Okay,
feeling.
all right. Well, I'll have to make a trip back out there. And by the way, thanks for wearing brown today. Katie didn't get the memo. But
No,
I
apparently not.
appreciate the effort. Julia Fanzeras who helps lead our energy and oil coverage here. A closer look at some of those prices. And I mean, we kind of jest about the weather, but I mean, we've seen this before where the weather really has shut down a lot of the output coming out of those basins.
Yeah, and Julia makes a great point that, of course, traders are still waiting here, but it definitely seems that the weather and the ripples that's causing is having much more of an impact than geopolitics at this point.
Yeah, absolutely. We'll give you a better breakdown here of what's been going on in the energy and commodities space with our commodities close after the break, and a lot more coverage coming up as well here. Stick with us right here on The Close on Bloomberg. This is the countdown to the close, looking at an equity market that remains on the back foot, a bit of a sell-off right now in the Treasury space. But let's get a check on what's happening in commodities. Commodities close right now here at the 230 mark. Taking a look at WTI crude, which looks like it's going to settle just slightly lower than where it was at the end of last week here. We should point out that it's been stuck in a relatively narrow trading range. And this is even, as Julia Fanzeras was pointing out, all the disruptions going on in the Red Sea. Natural gas futures, second line of your screen here in New York, slumping here despite the extremely cold weather. And this is largely because most people don't expect that cold weather to persist. We are in store for warmer weather here in the Northeast. And we should also point out the U.S. storage of natural gas right now running several percentage points above the 5-year average. Coffee futures getting a bid here, particularly the Robusta futures. And this is after a lot of the growers in Vietnam are holding out for higher prices, and corn futures moving lower down for a fourth day. And this is also a supply story. And remember, the CFTC data that we got coming out of last week showing that short bets on corn still at elevated levels. All right, let's pivot from that and go back into the world of M&A. We learned about a couple of deals being announced, but now learning about a potential deal that could be blocked. A federal judge saying that he is not going to go along with JetBlue's $3.8 billion acquisition of Spirit. The judge finding the deal would stifle competition and raise fares for consumers. The big question now, is what's next. Bloomberg opinion columnist Brooke Sutherland joining us to talk a little bit more about this. And of course, just because a federal judge says no doesn't mean it's not going to happen. The big question I have, Brooke, is whether the new CEO taking over JetBlue is going to have the same appetite for this deal as her predecessor.
I think that is the question. And to your point, Spirit and JetBlue could appeal this ruling. I think it is debatable whether JetBlue should want to do that. It is a very different environment for U.S. airlines than it was in the summer of 2022 when JetBlue and Spirit first agreed to these terms that they're now fighting for. We went from having airlines scrambling to keep up with the resurgence in travel demand post-pandemic to a glut of capacity in the domestic market. And I think that the rationale for this deal looks a lot different in the current environment for airlines. And the price also looks very high relative to, you look at Spirit is forecast to have a loss this year and for the foreseeable future. Does the price tag, which was very high and boosted by the bidding war with Frontier, still make sense? I think that is highly debatable.
Well, Brooke, to that point, you take a look at JetBlue shares right now, currently up about 6%. Maybe we can call that a relief rally. But then you take a look at Spirit. Shares currently down 48%. They got as low as nearly 61% lower. The fact that this has fallen apart, gotten blocked once again, where does this leave Spirit?
I think that is really the interesting question here, because there was a, thought maybe at some point that Frontier could come back to this deal if it did indeed get blocked by regulators. I think that looks a lot more difficult now, because you've now had regulators block not only the JetBlue Spirit transaction, but also JetBlue's marketing alliance with American Airlines. This is not an environment that is very hospitable to airline deals. And I think for Frontier to wade back into this and try to acquire Spirit would be very risky. Now, I think you have to wonder, what Spirit's future looks like as an independent company. They are losing money. And I think that it's fair to wonder how they're able to compete in this world that is not really advantaging low-cost carriers in the way that it was. There's been sort of a structural reset on labor costs across the airline ecosystem. Now, that's a lot easier to absorb if you're a Delta, United, American, although even they may have challenges managing that rising cost if you do start to see a drop-off in revenue. But that is a very tough environment for a low-cost carrier. They're also dealing with a significant chunk of their fleet are those Airbus A320 jets that are powered by the RTX jet engines that have been recalled. So they're getting hit very hard by that. I mean, they have a wide range of issues, and it is going to be no small task to deal with all of those.
This also raises a question, too, also about the health of JetBlue itself. I mean, it's been dealing with increasing competition and some of the moves that it has made, I guess, to sort of either boost its profitability or lower its costs, one and the same to be sure, has rankled a lot of consumers. And we've seen that show up in some of the trends in terms of where people are buying tickets and how that affects the bottom line.
Sure. Yeah, no, JetBlue certainly isn't immune to the challenges that are affecting Spirit. I mean, I think they're dealing with the same sort of problems where it's not like travel demand has fallen off of a cliff in the U.S. The consumer is still holding in there relatively well in the U.S., but the airlines added too many seats. And so we're just not seeing the growth for travel proportionate to the number of seats that the airlines have on offer. And so a number of airlines have had to discount tickets, including JetBlue and Spirit, to try to fill up those seats. But that creates a problem because you also have costs rising, where it costs more money to operate those planes, to staff those planes. You've had a lot of volatility in fuel costs, and to then be getting hit on the revenue end as well is not a sustainable dynamic for these airlines.
All right, Brooke, really appreciate your insight. That is Bloomberg Opinion's Brooke Sutherland. And what an interesting end potentially to this deal. According to reporting, I mean, JetBlue has been considering Spirit in some form since about 2017, so quite a long time there. Yeah,
but I mean, when you look at the drop in Spirit today, I think you get a sense that investors realize this might be just not a fight that's worth fighting. And I think the idea that you have a transition at the top of JetBlue is going to complicate things, right?
Yeah.
If the person who had announced this deal was going to be around to sort of shepherd this through whatever the next legal fight, then maybe great. But with Robin Hayes stepping down and passing the baton over to Garrity, it just kind of makes you wonder whether it's something she even wants to deal with right now.
Exactly. And to that point, I mean, Brooks, Brooks said, I mean, you think about the environment under which this deal was conceived, the airline industry at the time is very different than the airline industry that we're contending with right now.
JetBlue used to be like kind of like the fun airline to fly. It was relatively inexpensive. You know, remember they were newer planes. They had the little seat back things back when that was still kind of a novel thing, at least in economy. Yeah. And now, I don't know, the last few times I've flown it, it's just like, it's just another airline.
I like flying no matter what. It's not a great experience. And
quicker than horseback.
That's true. It is fast. So we'll continue to track.
It has that. That's the key advantage there.
That's
the moat, as we say.
The moat, it goes places fast. Still ahead, though. Jeffries says playtime is over for the toy industry. We'll talk to the analyst behind the call about why he says Hasbro is one of his top picks.
I love how these are all adults playing with these.
Oh, yeah, big time. Toys are for adults. This is The Close on Bloomberg.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Boeing. Wells Fargo downgrading the stock to equal weight as the plane maker's deliveries may be hurt by the FAA's probe into 737 MAX 9 quality control issues. The analyst says given Boeing's recent track record and the greater incentive for the FAA to find problems, we, quote, think the odds of a clean audit are low. Shares flying lower here, down 8% on the day. Next up, let's take a look at PayPal, getting cut to neutral over at Mizuho amid, quote, intensifying competition in the space, especially from Apple Pay. The analyst also sees younger users gravitating to newer payment methods. That includes things like autofill as well as all those buy now, pay later services. PayPal down 4.5%. And finally, Western Digital picking up an upgrade today from Barclays. The analyst going to overweight, saying 2024 and 2025 should see better demand for flash and hard disk drives. The price target, that's also being lifted, $65 up from $45. The shares up 4% on the day. And those are some of our top calls. Let's stay in the sell side space here and pivot to the sector behind every child's dream, and according to our recent tease, maybe some adults as well. The toy industry. U.S. toy prices have fallen over the past year as toy makers struggle with post-pandemic overstock and big shifts in the way consumers spend and the way kids play. Some analysts say those challenges will continue this year before returning to growth. Let's get some insights out of Andrew Urquhart over at Jeffries, who's been covering this sector over at Jeffries. And Andrew, I am curious. I mean, looking at the most recent earnings we got out of Hasbro and Mattel, you would think that apparently nobody's playing with toys anymore. Is this sort of a one-off type of thing where we're just going through some sort of trough in the cycle? Or is this more structural, that we're just seeing a big change in what we do when it comes to the toy industry?
I think we are in a trough. I think we are in a longer-term cycle change. So let me kind of go through that quickly. On the trough side, you've had many problems all come to a head at the same time. You've had supply chain issues, consumer behavior changes this year, right? A lot more travel in 23, less consumer goods. And then you had a really poor box office, right? Your big box office action hero movies did poorly. Your animation movies did poorly, and you put all that together, and people are just buying fewer toys this particular year, and caused all sorts of inventory issues. And that's why for 2023 the industry's down 5%. Yeah. Now looking out further, yes, I think some of these problems persist, primarily kind of that box office issue. And primarily that change in behavior. Yeah. During COVID, people were buying an excess of toys, and it's going to take several years to kind of come back down to a new normal. Yeah. And so we think 24 is going to be another down year.
I am curious about the inventory side of this and how quickly the toy industry can pivot. Just to kind of draw an analogy, I mean, when we kind of look at the fashion industry and the way they've sort of found a way, I guess, to do more real time, if you will, changes on the fly to keep up with styles and trends here, how much wiggle room, I guess, does the toy industry have to pivot and to address some of these inventory issues without falling behind the trend?
Yeah, that's really difficult in the toy industry, in the physical toy industry, right? Games and digital games, video games, stuff very easy. In physical toys, very difficult. You take your big retailers; they're already thinking about what they want to put on the shelf for holiday 2024, 11 months away, right? And they got to think about which movies are going to be big movies, which ones, and that takes a lot of planning, takes a lot of supply chain management. And if, a Marvel movie doesn't do quite as well, or a Pixar movie doesn't do quite as well, or the opposite can happen, a Mario movie could surprise, it's not that easy to pivot, not that easy to fill shelves or draw down inventory. So it is a very difficult industry to be in.
Andrew, I want to get your thoughts on the concept of iPad kids. That's kind of a meme that's been running around social media for a while. You mentioned that people are buying fewer toys. Is that just normalization from the pandemic, or in general, are parents buying fewer toys, letting their kids loose on iPads earlier, and kids moving over to video games at an earlier age?
Yeah, so we're in that latter camp. I think most people in the industry are in the former. I think most people say, hey, this is just COVID digestion. As we've started to look at some of the numbers, toy spend, physical toy spend relative to the GDP, or toy spend relative to the consumer wallet, it is declining on the physical toy side. And we could only believe that is a longer term trend that is impacted by iPads, mobile devices, younger and younger games like Roblox and others that are out there that just are drawing a lot of eyeballs and time and time spent. The other one that's probably underlying it too is just toys is a very visceral buying experience. You want to go to the store, you want to see it, you want to feel it, you want to have the kids pick it out. It's almost like an experience. But if you're going to Walmart, Target, and no longer going to Toys R Us, that experience is just happening less. So if you're running to a birthday party, you may just be getting a gift card to Roblox, right? Instead of going to that store and picking something out.
Yeah, it's a fascinating conversation. When you think about the companies in your coverage, who is best positioned to adjust to that potentially new reality of, you just have kids playing a lot more video games?
Yeah, so you have Mattel and Hasbro, the two biggest publicly traded companies. Mattel's gone after just to be a highly efficient toy manufacturer with really great brands. They've done a wonderful job at that. But our issue there is you're only going to grow at maybe the industry slightly faster. Hasbro, on the other hand, has said, you know what? We're going to try to optimize our toys, and instead we're going to lean into some of these digital trends. And so, luckily for them, they own some of the biggest brands like Dungeons and Dragons. They own G.I. Joe. They own Transformers. They own Magic the Gathering. These are all nice, great IPs that can be digitized. They also have a great board game portfolio, Monopoly, for example. Right? A very old brand. You can easily digitize that. They made a mobile game last year called Monopoly Go. It was the fastest mobile game to $1 billion since Pokemon Go. That's the power of these brands. That if you can figure out a way to tap into that digital side, it can be extremely lucrative.
Yeah, well said. Andrew, we're going to have to leave it there. Andrew Urquhart over at Jefferies, a closer look at the toy industry and some of the problems affecting it. And Katie, I thought it was interesting, two interesting things was really the lack of sort of a big toy retailer. I think that plays into it, too. Yeah. Because, I think about, when my son was young, you go to the store, that's where you sort of pick out the toys you want. You don't really have that same exposure if you're just taking them to, the Safeway or whatever, grocery store you're going to. And then also advertising. Yeah. Kids don't watch TV the way, and they would be bombarded with advertising during those things. Now, they're not really. Yeah,
when they're watching YouTube ads, they have the sound off, et cetera. I don't know if metaverse advertising has quite reached them yet, but.
It has not.
No.
Although I met somebody over the weekend who was wearing one of those metaverse glasses.
Interesting. Did you meet them?
I did. And Newberger coming up next, Deputy National Security Advisor for Cyber and Emerging Technology. We're going to sit down to discuss where cybersecurity is today. That's coming up on our Wall Street Week Daily segment right here on The Close on Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week daily segment. David Weston joining us right now, the host of Wall Street Week, with the focus today on cybersecurity and AI.
Yeah, exactly. Business, as you know, spends so much time and money on cybersecurity. So we went to the person at the White House who's responsible for it, Ann Neuberger. She's Deputy National Security Advisor for Cyber and Emerging Technology, which means AI. This is what she had to say.
So as we think about cybersecurity threats, they're really in two categories, countries and criminals. And we see cyberspace linked in to the geopolitical environment very closely. So, for example, just 24 hours before Russia began its invasion of Ukraine, they disrupted a satellite communications company providing military communications for Ukraine. Similarly, we see the North Koreans use hacking of crypto infrastructure to get around very rigorous sanctions and fund their missile program. So that's the threat from particular countries. On the criminal side, ransomware threats against companies, hospitals, state and local infrastructure is up 45% year over year. That's driven by criminals around the world, the majority of which are actually in Russia. So the government's efforts and really the deeper partnership the Biden administration has built with the private sector has been focused on the kind of approaches that would both counter the national and the criminal threat.
So as you suggest, Ann, it's both a private company issue and a government issue at the same time. How do those two things connect up? I mean, what are the respective responsibilities of the private company to defend themselves and also the government to help?
On the private sector side, the key approach really is companies locking their digital doors, backing up their systems, ensuring that vulnerabilities are patched quickly, because we still see threats being successful with pretty basic approaches. I'll give an example. The Iranian government disrupted water systems in a number of states a couple of months ago, and they leveraged default passwords on those internet-connected water systems. We can get ahead of that by patching systems quickly. That's one approach. The second thing we need is for companies to build tech to be able to be defensible against the threat. That's the reason the U.S. government launched the Cyber Trust Mark program, a light touch government program to work with companies producing tech to say if they meet the government standard for cybersecurity, they can bear a label. Think of it as Energy Star for cyber, so that consumers, companies who are shopping for whether it's a home security device, whether it's a smart router for work, can buy tech that's built far more securely. And then on the government side, there's been a series of approaches. First, international partnerships we've built, like the Counter Ransomware Initiative, that brings together 50 countries to focus on taking down the infrastructure, policies that make it harder for criminals to disrupt hospitals and schools, as well as efforts like sanctioning mixers that move the cryptocurrency that finances ransomware, or takedowns of infrastructure around the world that both countries and criminals use to conduct their cyber attacks.
And you also have responsibility for artificial intelligence. Now we call it generative artificial intelligence, those large language models. Give us your sense from the White House right now about the potential for this, for good and maybe even for ill.
Artificial intelligence is a transformative technology, and it has significant promise and peril across many areas of our economy. It's one of the reasons that the President's Chief of Staff has really been overseeing this effort in a very significant way. On the peril side, again, we see threats from both countries and criminals. Think about this technology, for example, in the hands of someone like President Putin, who has a history of focused efforts on compromise or disinformation, the ability to generate deep fakes, very realistic looking videos, pictures, is a threat we're concerned about and working closely with the private sector on. Similarly, I talked about the criminal aspect of cybersecurity. In the hands of criminals who can accelerate developing malware, potentially accelerating the synthesis of biotechnologies, that's a real concern as well. From a broader societal perspective, we also have concerns about AI augmenting bias in loan programs, potentially the risks to students learning. So those are all areas that we're focused on, both the perils of AI from a national security perspective and the perils of AI from a broader societal perspective, even as we double down and think about how to glean the promises, which are also very transformative.
As a way of addressing some of those issues, I've read about so-called watermarking, which might give us a sense as we consume some of this information where it comes from, to get a sense of its genesis. Where are we with watermarking? Is that something that the private sector can do in itself? Does the government have to play a role?
Watermarking has a lot of promise in countering disinformation. It's one of the reasons that when the president negotiated a set of voluntary commitments from leading AI companies, watermarking was one of them. Because what watermarking does is have an invisible and in some cases visible mark that is included when AI generates content, videos, pictures, and then platforms would display for the consumer that this content was indeed generated by AI. So it's a way to tell people looking at a video or looking at a picture, this content was generated by artificial intelligence, and potentially cue them to think about, is this accurate? Is this real? What might be the purpose of showing this particular content?
That was Ann Neuberger. She's Deputy National Security Council Advisor for Cyber and Emerging Technology. Tomorrow, Romaine, we're going to be hearing from Ruchir Sharma of Rockefeller about his trends for the new year. And on Friday, Wall Street Week will welcome Blair Efron from Centerview Partners. That will be on Friday at 6 p.m. New York time.
All right, and you can check David Weston every day around this time for our Wall Street Week daily segment right here on The Close as we round out into the final hour of trading here on the first trading day of the holiday shortened trading week. Stocks on the back foot, pretty much right where they left off last week here. A big focus right now on some of the economic data afoot and a big focus on the earnings as well. This is Bloomberg. It's just about 3 p.m. here in New York. This is the countdown to the close. Let's get a view of what's going on in the markets. I'm Romaine Bostick.
And I'm Katie Greifeld.
We talk about a market, at least an equity market, Katie, that kind of is doing exactly what it did the last few sessions here, and that's really start to shift backwards, right? Mm-hmm. This idea that, I don't know if it's just profit taking coming off the big gains from last year, or whether there is some serious trepidation here about economic conditions or whether the Fed is really going to have folks back.
Yeah, so pick your poison here. What I do know is that we were slowly inching towards that all-time high. Now we're slowly inching away. Of course, that all-time high, that all-time closing high about 4,800, just a hair below, and feels kind of far away right now.
Absolutely. You take a look at an S&P 500 at 4760, only down about 0.5% here on the day, but you're seeing continued strength in the dollar. Of course, the yield shifting higher, yield curve shifting higher, I should say, here on the day. Keep an eye on bank stocks too here. KBW Bank Index moving lower. The regional bank index also lower on the day as well. Financials not getting a lot of love.
No, it doesn't help that Morgan Stanley shares currently on track for their worst day since October. So definitely a disappointment there, and a mixed bag at Goldman. Obviously not enough to sort of change the narrative there for the big banks.
Solomon's taking his victory lap. This is the year here of where they really sort of break out, according to him. So we'll see here. I'll flip it up here because there are still some concerns about economic conditions. We did get the New York Empire State Manufacturing Index here. That was down once again. Remember, it's been in contraction for a while, but it's still raising a lot of concerns as to whether there is a broader picture here, a broader story here about this slump in manufacturing and how much it affects the economy, with the big asterisks here that, of course, manufacturing is a much smaller part of the economy than in the past.
Of course, but an important signal nonetheless, of course, as we try to determine whether or not we're going to get that mythical soft landing that the Fed has all but promised at this point. But let's talk about
It's real to me, Katie. It's not mythical.
It's not. Yeah. It's real, just like the Loch Ness Monster. Let's talk about some single names here. AMD having a great day.
Are the Yeti and Sasquatch the same thing?
I don't know. No. I think they're the same sort of idea. You know, big hairy guy runs around in the woods. AMD, though,
I had a friend like that once.
It's having a great day of about 7.7%. That's as the chip maker is seeing a lot of price target upgrades from the likes of Barclays and Susquehanna. You can see that is boosting shares by quite a bit. Moving along, I also want to talk about Apple because what an interesting day for Apple. There's a whole host of news to pick from. Yeah. I'm going to pick this headline.
Which
the Supreme Court rejecting Apple's bid for an Epic App Store review. But of course, there were some other negative headlines out about Apple. Of course, when it comes to the smartwatches, sort of abandoning that blood oxygen feature.
Yeah, I had a great conversation with my barber the other day. He wasn't aware of this case, and he went to buy an Apple Watch and was kind of disappointed they didn't have the latest versions. And I had to explain to him that he should be watching Bloomberg TV all day long instead of hip hop videos.
Bloomberg News.
So, he would know this.
Let's quickly talk about Boeing and what we're seeing going on there. There is concern that what we're seeing with its MAX 737s, that's going to slow deliveries. I would say that is a big concern. We've heard it a lot. Shares down about 8% at the moment.
Yeah, I don't know. This is a big issue, but we'll continue to follow that story as well as the other big market moves of the day with our cross-platform coverage of today's top stories. That starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick here with Katie Greifeld, and we're joined right now by her colleagues Carol Masser and Tim Stenovic. Yes, I remembered your name, Katie Greifeld.
Okay, you got it. You got there.
It's a long weekend.
A little bit of a senior moment. You know, it's like a rotating K. I had to turn over. Oh, it's Katie today.
It's me. Many syllables.
Anyway, I'm happy to have Katie, happy to have Tim, and happy to have Carol Masser here as we welcome our audiences across all of our Bloomberg platforms. That was not in order, by the way, of preference.
No favorites. I figured. All right. So a really important story for us to get to. We know we're going to get one from you guys in just a moment. In the meantime, we wanted to highlight a recent survey from the New York Federal Reserve Bank. More Americans apparently are focused on paring down their debt. Specifically, they said if they got an unexpected 10% in income, what they would do. 38.4% said that they would use the extra money toward debt payments. That is the highest reading since August of 2016.
We should also note that the share of respondents who would spend or donate this sudden windfall, Romaine, dropped to the lowest on record since the series began back in August of 2015. So what that tells us is that the consumer is facing increased pressure. U.S. households are facing increased pressure, and they're relying more on credit cards in recent months.
Yeah, this is interesting. I mean, I guess on one hand, it's encouraging that people would focus on addressing this before, I guess, it got too out of hand. Of course, the flip side of that is that means that people are going to be spending less on some of those discretionary things that kind of keep this economy afloat. So you do wonder how that all sort of intertwines.
I have some lighter fare for us because
I said it was a really important story.
It is important. Let's talk about Succession because we are in award season and Succession just swept the Emmys last night. It won Best Drama for the third time in 4 years. HBO once again claiming the crown as the premier programmer in TV. I like the description of Succession in this Bloomberg News article, a darkly comic show. I loved Succession so much. I assume everyone on this simulcast has seen Succession at this point.
Yeah, but no spoilers.
Yeah,
okay.
Yeah, no spoilers. I can't wait for the next season, but what's going to happen?
I'm the eldest boy.
Oh. This is great. I mean, some other things won, as you see in the background there in the white tux. That's the lead actor from The Bear. They did well as well.
Yeah.
Have you seen that show?
Yeah, you know, I watched the first season. I'm like a few episodes into the second season. It's not really grabbing me. I don't understand how it's a comedy. I know that there are some jokes in there, but more than anything, it just stresses me out.
I think what's interesting about this story is that, and they write about it, is that you've got Hollywood, you've got so many of the kind of traditional folks who have been creating content and media for a long time, and they are not necessarily the ones that are being recognized with awards. And you've got HBO. I think the stat was that they earned the most nominations of any network, captured the most awards overall. So HBO really a standout.
And there was concern years ago that HBO would sort of lose its magic with Richard Plepler leaving years ago and so many different owners of HBO and what the future of HBO is. So turns out they can still, produce very, very high quality content.
I think it's interesting, and all the media companies are already crowing about how many of these various Emmys that they won, Netflix and the like here. I thought it was interesting, though. There was a great story in the New York Times today, just like one of our competitors. It really talked about kind of the end of peak TV, the idea that in 2023 you had something like a grand total of 599 scripted programs be released last year, and that basically we'll never see that number again, at least not anytime soon. That basically we've already seen the retrenchment. So I guess that'll make picking an Emmy winner a little easier over the next few years.
Maybe hopefully quality, not quantity.
Yeah, I was going to say also for the viewer, maybe that will make things a little bit easier. I can't decide what to watch. I mean, we sit down for dinner, not to bring you into my living room, and we just scroll and try to pick a show.
Fargo, the new season of Fargo.
I don't know.
Wait, you do this while you're eating dinner?
Good.
Please bring us into your living room.
Do you actually talk to each other, or you just
we talk about what to watch on
cats
TV?
there, like watching too?
Hey,
yeah, it's a cozy scene.
Before we go, did you know that HBO auctioned off some of the stuff from Succession?
No.
Yeah, I saw that.
And they made a lot of money, like $600,000, just auctioning the stuff off.
That's
you could have
cool.
bought the sausages that were used and bore on the floor.
Now, does that go straight into David Zaslav's account?
It's
How does that
half
work?
to HBO and half to the auction house, I believe.
Okay.
Maybe not split half and half, but
okay.
Yeah.
By the way, I keep my phone by my side because I'm waiting for them to call to let us know that the simulcast here on Bloomberg Television has now won that daytime Emmy, but maybe
It's
next
coming.
year.
It's coming.
I don't know.
There's not a category that could fit us.
Not yet.
We're
I
genre.
like that.
We're genre bending.
Tim, you're going to make
okay?
a great PR person one day.
One day.
Can we create a category? Didn't the Globes create a category this year?
Maybe sooner than later if we don't end this simulcast right now.
All right, we're going to end. Otherwise, producers are going to yell at us. All right, that's a wrap, guys. We're going to see you in less than an hour's time. We're going to wrap up the trading day on this Tuesday. Radio, TV, YouTube, Bloomberg Originals. We'll see you for Beyond the Bell.
And we continue our coverage right here on Bloomberg Television, counting it down to the close just about 50 minutes ago until we get to those bells. And there was an interesting call out today by the folks over at Citi. Strategists led by Chris Montague are expecting U.S. tech stocks to continue posting positive surprises out of that fourth quarter earnings season. They're also noting that energy and utilities will likely be the big disappointments here. So as everyone tries to reposition for what the big winners are going to be in 2024, let's see what our next guest thinks about those prospects. Mo Hagbin joining us, head of the Solutions Group over at Invesco. Mo, great to see you here. First time of the new year. And everybody really kind of wants to know, is this going to be kind of a repeat of what we saw at the start of last year, where it really was about a lot of those big cap tech stocks, or can we maybe look to something a little bit broader?
Yeah, well, thanks for having me, Romaine and Katie. I think you are absolutely right. You know, there is a little bit of is kind of the past, the future, and tech stocks have been obviously the big winners in the equity market. Although, you know, towards the end of the year, we did see some broader participation with value in smaller and mid-cap stocks getting a bid. So, you know, overall, I think we continue to be favorable, the equity market, and mostly because historically, when you think about peak inflation and peak rates, that tends to be favorable to equities in the subsequent quarters and years. That said, we did have a pretty nice run up in November and December, and January tends to be a time where both institutional investors and even financial advisors and retail investors are rethinking their positioning. So some volatility and some choppiness in markets is to be expected. Longer term, though, you know, we still are in the soft landing category. We think the Fed has done a nice job with the dual mandate. Inflation is coming down meaningfully, and the initial jobless claims and the unemployment numbers still look pretty healthy.
When it comes to the idea of people sort of maybe finding a little bit, I guess, greener pastures outside of those big cap tech stocks, that really begs the question here of a lot of those cyclical names, of a lot of those small cap names and mid cap names for that matter, that actually did post a relatively sizable rally towards the latter end of last year. But that sort of trade, it seems like it's just kind of waned. And I'm curious as to what gets people back. Is it strictly about confidence in the economic situation, more importantly, confidence that the Fed won't be in the way?
I think it's rates and it's the economy. You know, the rates situation has changed a little bit over the last couple of days. I think the market has priced 5 to 6 cuts this year. We did get some feedback around that, and I think there has been some repricing. Overall, we've been kind of guiding towards maybe a little bit more conservatism than what the market is expecting. Now, if rates come down meaningfully, that does tend to help with longer duration parts of the equity market. So tech would benefit from that. You know, small and mid-cap stocks generally tend to do better in a rising rate environment when the economy is really strong and better than expected. And what we're seeing in the last couple of quarters, and really just the U.S. market, the U.S. economic environment has kind of changed a bit, Romaine. We are seeing a bit of a slowdown in growth, which is the first time we've seen that in a while. The U.S. had led growth globally for some time, and we are seeing a little bit of a soft patch here. So when we think about global growth, it's much more synchronized now than it has been in the past. The U.S. is starting to join kind of developed markets outside the U.S. and China in this kind of below trend growth environment, and that should probably proceed for some time.
I actually want to talk about small caps a little bit more because, as you mentioned, rising rates, typically you would expect that would be good news for small caps. The economy is strong. That's good for those little guys. Is that still the narrative behind that group, though? Because you think about what we saw while the Fed was actually tightening, was actually raising rates, and it added up to some big underperformance from the small caps. Is that still the guide to go on, or do you think that falling rates will actually be a boon this time around?
I still think falling rates would probably be a bit more favorable for larger cap, mega cap, and tech names. I do think that the difference here is the economy, right? So economic growth slowing down in the U.S., that could be for the next couple of quarters a bit more pressure on equities. But over a longer period of time or a medium-term outlook, what I like to do is kind of think back to the early 80s when we saw an inflation situation that resembles what we're going through today. And we saw a pretty significant outperformance in equities post-peak inflation and post-peak rates. And I think we could probably agree that we're done tightening. The question is, how much are we going to cut and what's the speed of those cuts? I think on our side, we're probably a bit more cautious around that and thinking that it's going to be a bit slower and more data dependent than the market expects.
All right, Mo, got to leave it there. Hope to catch up with you again soon. That is Mo Hagbin. He is head of the solutions group over at Invesco. Now coming up, Trump wins big in Iowa, tightening his grip on the Republican presidential nomination. We'll break down those results next.
And we're going to go out to Davos here, where artificial intelligence has been a major topic of discussion. Highlights from our interviews with Sam Altman of OpenAI, Satya Nadella at Microsoft, and Ruth Porat over at Alphabet.
And Restaurant Brands beefs up its push for a Burger King turnaround. We'll get into the meat and potatoes of that deal. All that and more coming up. This is The Close on Bloomberg.
This week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As markets anticipate a dovish pivot by central banks, policymakers grapple with two wars on the global stage, and AI continues to dominate the tech headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Continuing coverage this week, only on Bloomberg Television and Radio.
Just about 43 minutes until we get to the closing bells here on the first trading day of the holiday-shortened trading week. Chip stocks are really your big advances here on the day. AMD having a phenomenal day, up about 8% on the back of some price target upgrades. But, well, the rest of the space not doing so well. You see that in energy stocks. You see that in manufacturing. You see that in tech. And you see it in a big way right now in the banking sector. Now that we've gotten most of the big banks out of the way, we move to the regional banks, but don't expect much of a different tone than what we've already heard. The net effect of it all is a market across the board which is moving lower, 0.5% on the S&P 500. The Russell 2000 and some of the cyclical names moving way lower than that. Remember, that's largely on the fact of a lot of the regional banks moving lower here on the day. As for some of the bright spots out there, keep an eye on Tilray, a 10% gain on that stock. It's only at $2 a share, but remember, that stock has rallied about 50% in pretty short order here, and that's not necessarily on the back of marijuana sales. A lot of this has to do more with some of their alcoholic drinks, which have actually gained some traction. Keep an eye on Carroll's Restaurant Group, up 13% on the back of the news that Restaurant Brands plans to buy the company here. You see the Philadelphia Semiconductor Index getting a strong bid here on the day, Katie. And those is a nice little wrap up of where we stand right now heading into the close. Katie?
Well, let's, before we get to the close, go back to Davos, the World Economic Forum, where the future of artificial intelligence has been a central theme. With the U.S. general election looming in November, OpenAI CEO Sam Altman discussed what's at stake for American politics and AI's impact on the labor force.
I think there's a lot at stake at this election. I think elections are, huge deals. I believe that America is going to be fine, no matter what happens in this election. I believe that AI is going to be fine no matter what happens in this election, and we will have to work very hard to make it so. But this is not, no one wants to sit up here and hear me rant about politics, so I'm going to stop after this, I promise. But I think there has been a real failure to sort of learn lessons about what's kind of working for the citizens of America and what's not.
There are political figures in the U.S. and around the world, like Donald Trump, who have successfully tapped into a feeling of dislocation, anger of the working class, the feeling of exacerbating inequality or technology leaving people behind. Is there the danger that AI furthers those trends?
Yes, for sure. I think that's something to think about. But one of the things that surprised us very pleasantly on the upside. Because when you start building a technology, you start doing research, you kind of say, well, we'll follow where the science leads us. And then when you put a product, you'll say, this is going to co-evolve with society, and we'll follow where users lead us. But it's not, you get to steer it, but only somewhat. There's some which is just like, this is what the technology can do, this is how people want to use it, and this is what it's capable of. And this has been much more of a tool than I think we expected. It is not yet, and again, in the future it'll get better, but it's not yet like replacing jobs in the way, or to the degree that people thought it was going to. It is this incredible tool for productivity. And you can see people magnifying what they can do by a factor of 2 or 5, or in some way that doesn't even make sense to talk about a number because they just couldn't do the things at all before. And that is, I think, quite exciting. This new vision of the future that we didn't really see when we started. We kind of didn't know how it was going to go, and very thankful the technology did go in this direction. But where this is a tool that magnifies what humans do, lets people do their jobs better, lets the AI do parts of jobs, and of course jobs will change, and of course some jobs will totally go away. But the human drives are so strong, and the sort of way that society works is so strong, that I think, and I can't believe I'm saying this because it would have sounded like an ungrammatical sentence to me at some point, but I think AGI will get developed in the reasonably close-ish future, and it'll change the world much less than we all think. It'll change jobs much less than we all think. And again, that sounds, I may be wrong again now, but that wouldn't have even compiled for me as a sentence at some point, given my conception then of how AGI was going to go.
As you've watched the technology develop, have you both changed your views on how significant the job dislocation and disruption will be as AGI comes into focus?
You hear a coder say, okay, I'm like 2 times more productive, 3 times more productive, whatever, than they used to be. And I can never code again without this tool. You mostly hear that from the younger ones, but it turns out, and I think this will be true for a lot of industries, the world just needs a lot more code than we have people to write right now. And so it's not like we run out of demand, it's that people can just do more. Expectations go up, but ability goes up too.
And that's Sam Altman, of course, the man of the moment, CEO over at OpenAI. He was out at Davos speaking at our Bloomberg house, where we have some of the biggest and best people sit down and really kind of open up to talk a lot. And I thought it was interesting, some of his comments about the election. He seemed not too concerned about it, though we should point out everyone else is concerned about it. Also, that was interesting, too, to juxtapose that conversation with one that we heard from Satya Nadella, also on those same chairs that we were looking at here, where he kind of talked about the turmoil at OpenAI last year and the idea that Microsoft doesn't necessarily want control over OpenAI, it just wants stability.
Just stability, doesn't want to actually man the ship there. I thought that was really interesting.
Yeah.
I mean, that interview produced a number of sound bites that we could talk about, but like you said, man of the moment. You think about the turmoil that we saw at OpenAI, but we heard from the man himself.
Yeah, absolutely. Here, we'll see whether he does anything when it comes to some of the concerns here heading into what is going to be a pivotal year for elections worldwide. Stick with us. A lot more coming up right here on The Close on Bloomberg.
A turnaround plan at Restaurant Brands. The owner of Burger King plans to buy its largest U.S. franchisee for about $1 billion in cash. That's all in a bid to fast-track an overhaul of hundreds of locations and win back customers. We're talking about Carrols Restaurant Group here. It expects Restaurant Brands International expects to complete its purchase of Carrols in the second quarter and spend a further $500 million to remodel about 600 of Carrols' more than 1,000 locations.
Yeah, this is an interesting move by Restaurant Brands. I guess that scale makes sense. I was going down the rabbit hole at Carrols because at first I was like, I had never heard of them. It was actually a standalone restaurant called Carrols for years in New York State before our time. This is in the 60s and 70s.
Right.
And then at some point in the 70s, they decided it was better to be under the franchise tag of Burger King, Popeyes, and it made that pivot. And now it's got like 1,000 Burger King and Popeyes scattered around the nation.
And now Restaurant Brands wants a bunch of those back. It's going to be interesting to see what that looks like. Apparently, this could take several years when you think about, again, what they actually plan to do. We'll continue to track that story.
Are you a Burger King person?
Huge Burger King fan. This is The Close.
Are you?
On Bloomberg.
Oh, you're the one. This is the countdown to the close. Just about 30 minutes left to go here on the first trading day of the holiday shortened trading week. Katie Greifeld, and apparently this weekend it's starting off any better than last weekend did.
No, it's a little soggy if you take a look at the S&P 500. Not too much good news if you look at the sector level either. You take a look at what the screen is showing right now. You have 10 of 11 sectors in the red. Information technology, your lone gainer, of course, only up about 0.1% or so, and really it gets worse from there. You can go down the list right now. You can see at the bottom you have utilities, industrials, materials, and then energy once again resuming its position at the back of the pack, currently off about 2.2%, Romaine.
Well, let's actually start with technology, because there is a lot of strength that we're seeing in the semiconductor space here on this Tuesday afternoon. Advanced Micro Devices having a really great day, up about 7% right now. This on the back of some price target upgrades, including over at Barclays and a couple other places here. The idea here that there is sort of a cyclical trough that they've been taking a look at, combine that with sort of the potential tailwind from AI, and they're saying AMD is going to be a big beneficiary from that. Meanwhile, you take it Applied Digital here. Remember, this is a company that really kind of helps to build out data centers here. They actually lowered their forecast. Remember, the data center business was really what propped up a big part of the chip business before AI took over, but apparently the bloom is coming off that rose. A massive downward day here for Applied, down 24%. And then Ansys taking a leg lower here. This is an interesting story. Remember, we heard from Synopsys a little bit earlier here, the idea that they're willing to buy this company for $34 billion. Synopsys, of course, it basically helps folks design chips. They create the software to design chips, and it's an Ansys that basically makes the software that allows you to test that end design here. So a lot of synergies there, but some big questions here about how this is going to be paid for and just how much synergy there can be. And then meanwhile, we continue to keep an eye on what's been going on in the crypto space. One of the more higher volume of the new ETFs, the iShares Bitcoin Trust, IBIT, taking a little bit leg lower here for a second day of trading, down by 1%, Katie.
And let's stay in the crypto space, because after years of speculation, Cantor Fitzgerald CEO Howard Lutnick told Bloomberg TV that his firm has reviewed the balance sheet for stablecoin issuer Tether. He spoke earlier at the World Economic Forum over in Davos.
They have the money they say they had. In the last attestation, they said they had 86 billion of assets and 83 billion of liabilities. And I've seen a whole lot, and the firm has seen a whole lot, and they have the money.
And let's broaden things out now with Marshall Beard. He is the COO of Gemini, joining us on set. Bad weather couldn't keep him away. And Marshall, I won't ask you about Tether, but I do want to talk about the spot Bitcoin ETF custodian business, because Gemini, you're acting as the custodian on VanEck's product. Do you have any more ETF custody deals in the works right now?
Yes, so we are in discussions with lots of ETF issuers. Right now publicly with VanEck, and there's another on file called 7RCC Fund, but that is not launched yet.
Okay, and we talk about how crowded the spot Bitcoin field is, just from the product standpoint, from the custodian standpoint as well. It feels pretty crowded at this point. We were actually speaking to the Kraken CEO a little bit earlier today that said that Kraken is also going to offer a new crypto custody service. How do you compete when it comes to being a custodian? Is it just fees alone, or how do you actually differentiate yourself?
It's not just fees. I mean, that's obviously a part, but there's a lot of different things. It's relationships, it's brand, it's longevity. I like to see newer players in the space. There's only so many that can actually support this ecosystem in the US ETF issuance land. So, you compete on a myriad of different ways. Right now, there's only a few. Crypto is stored differently than traditional equities, right? There's a lot of cryptography behind it. And so, you need a lot of expertise there as well.
Do you worry at all that some of that expertise can actually be found in some of the more traditional finance companies, a few that have made it clear they want to be a big player in the custody business as well?
Well, we haven't seen it yet. We've only seen it with Fidelity. And they've been working on that for quite some time, and I believe that they only custody for Bitcoin, no other crypto assets. So, it's probably going to take some time if that's the road. I think we saw NASDAQ announce that they wanted to do custody, but now they're not doing it anymore.
I do want to talk a little bit here about the reception of the Bitcoin ETFs, and I know it's only been 3 days since since we had the announcement, 3 business days. It gets to the question here as we move deeper into the year here, how much new adoption are we going to see? Meaning not just the folks who are already in the crypto universe, but maybe those folks who are on the sidelines wondering how the heck do you actually buy this thing, and now they have an avenue in theory to buy it in a much more efficient manner.
Yeah, so we're only on the third trading day. I don't have the specific numbers, but I think we've seen about $1 billion in aggregate net inflows. That's people coming out of GBTC and into some of these new funds. So about $1 billion, which I think in 3 days is incredible, right? And so, adoption is going to take a little bit. Education is important, getting brokers up to speed, getting wealth managers up to speed, getting these distribution channels. This is going to play out over months and months and months. So it's going to take some time, but there's massive distribution channels now.
Well, let's talk about some of the platforms who are saying no. And by some of the platforms, I mean Vanguard, obviously taking a strong stance there, saying that they don't plan to offer crypto ETFs, ETPs, or futures on their platform. What did you make of that? And do you think that we could see other platforms follow Vanguard's lead?
I don't really have a take. I don't know their investment thesis. Obviously, they're one of the largest asset managers in the world. People are going to have different ideas behind this. And so I think it is a little old school thinking. I think, this is a new technology. You see people come around over time. They probably will come around over time.
Yeah, we'll see the day. It has been interesting to watch their evolution when it comes to commodity ETFs, for example. But let's talk a little bit about
Are her
price
questions
action.
tough? She practices her questions on me first.
I look in the mirror and I yell at myself. But I want to talk about the price action. I want to get your take on what has been happening with the price of Bitcoin, because I'm sure people in the crypto industry are tired of hearing the phrase "sell the news" event. But is that what we saw?
A little bit. I think at its peak, we saw 49,000. I think right now it's trading around 43. So there was a little bit of sell-off, but, Bitcoin was up, I think, 160% last year, up a couple percent today, I believe. So, I'm not worried about right now. I think what we see today is pretty orderly. I like to see this with the ETFs launching, the operations between the issuers and the custodians and the APs is all working fine, what looks like, right? Which is good. It shows maturity, but it seems orderly, a little boring, actually.
It's interesting, too. I'm curious as to what you made out of the actual decision itself, meaning the language, and more importantly, the statement that Gensler put out alongside of it here. It seemed to suggest this idea, obviously, from his perspective, that it was kind of like grudgingly, okay, fine, we have to approve this because the judge isn't going to give me any leeway. But he did kind of leave that door open for some sort of broader regulation, whether that's going to come under his purview or somebody else's, who knows. But is that something that you're preparing for?
Yes, of course. I mean, it's something that we're asking for, right? We've been doing this for a decade now, and, the U.S. does not have a broad crypto regulation framework where, so we are looking forward to that. I think it happens probably still 12, 18 months away.
Did it surprise you at all? And I know that the hand was kind of forced because of the lawsuit, but did it surprise you that they didn't maybe have that framework ready to go before they made these approvals?
Yes.
Yes.
Yeah. I mean, other countries have issued crypto-specific frameworks, right? This isn't a new thing. It's been around for quite some time. So, yeah.
All right, Marshall, really great to have you on set. Really appreciate your time as well. That is Marshall Beard, of course, the COO of Gemini. Now, coming up, it's the top 3, where we focus in on the top 3 movers and shakers at the center of the day's biggest stories. That's next. This is The Close on Bloomberg. All right, time now for the top 3. Every day at this time, we do a deep dive into the people at the center of today's top stories. Joining us now, Scarlet Fu. Scarlet Fu, who are you watching?
So I'm watching Erica Ayers-Badan. She's formerly Erica Nardini. She's the CEO of Barstool Sports and is now leaving the digital media company after about 8 years leading it. She took the Barstool brand mainstream. They expanded into podcasts, online video, and eventually a sale to Penn Entertainment.
Yeah, I'm kind of curious about this, too. I mean, because that whole mashup with Barstool being sold to Penn and then going back to Portnoy, and God knows what the heck they're doing with it now.
A whole round trip.
Maybe she just decided, okay, now's the time to sort of find a different gig here. I mean, 8 years is a long time, but particularly for a company with that much turmoil.
Oh, yeah. She was a busy CEO when you think not just about the ownership, but also I feel like they find themselves in controversy.
Navigating that controversy.
Exactly. It's going to be fascinating to see where she goes next.
Yeah, a fascinating person here for a less than fascinating company, Microsoft. How about that? They were on the couch at the Bloomberg house, I'm told. Satya Nadella had a chance to sit down and really open up here about OpenAI and all the turmoil from last year, making the case here, because there's been so much criticism that Microsoft's just trying to control the board here. He's basically saying they don't want control, they just want stability, and that was the big reason why they stepped in to really try to get Altman back after the board ousted him. Yeah, and it's, you remember, that was just in November. It feels both like yesterday and also a very long time ago. Let's take a listen as to what Nadella had to say.
I'm comfortable. I have no issues with any structure. What we just want is good stability. And as I said, we don't even need, like, I'm not even interested in a board seat, or we don't need, we definitely don't have control. We have no, we just want to have a good commercial partnership, and we want to be investors in the entity, in even the way they're structured. So what I would like is good governance and real stability. That's it. Yeah, Satya Nadella sitting down there with our very own there, talking a little bit about his future of OpenAI.
Yeah, what I found interesting was he said, we don't even want a seat on the board. And I was thinking, yet. I mean, right now, Microsoft has a non-voting board observer role, but if things go crazy the way they did in November, I'm guessing that they probably want to exercise that right to turn it into something more. Also interesting to weigh his comments against. We know that the UK, we know that the EU, their watchdogs are weighing probes of the Microsoft OpenAI relationship. So it's going to be fascinating to see how that one develops. But the third person I want to talk about is Ryan Cohen, the GameStop CEO. He's been seen as the Warren Buffett of the meme stock frenzy, but lately his strategy hasn't exactly been working too well.
Who called him the Warren Buffett of the meme stock?
It wasn't me. It was not me. Someone on social media, I'm guessing. Someone on social media said it, and we reported it. But let's talk about some of his holdings. Alibaba, it's fallen around 40% since Cohen's stake was first reported, and GameStop, its price has fallen over 80% from its peak. So that Midas meme stock touch, not working too well right now, Romain.
Yeah, I mean, if you're going to be the Warren Buffett of something, you actually have to deliver, returns for not only yourself, but also investors. And I think that's been the knock on him, right? I mean, despite the outsized success that he had with Chewy, there's been a lot of questions as to why he hasn't been able to replicate some of that success for other investors, because we should point out he's made a lot of money off some of these trades, but a lot of external investors here have been left holding the bag.
Although GameStop's board did give him the ability to use the company's excess cash in stock, so he'll have plenty of opportunities to try to make some of those investments come to fruition.
Sure he'll use it wisely there. Ryan Cohen, of course, who has been the man of the hour for the last few years, now looking at some losses here on some of his key investments. Coming up here as we count you down to the close, Brent Schutte joining us after the break. This is Bloomberg. This is the countdown to the close. Romain Bostic alongside Scarlett Fu with about 10 minutes until we get to the bells here. The new week starting off not much different than what we saw last week here with stocks on the back foot.
Yeah, and Fed Governor Chris Waller was really the pivotal voice today, sounding a little bit less dovish than what a lot of investors had anticipated and would have liked. And the takeaway here is no rush to cut rates in March. You're seeing stocks stuck with the S&P 500 remaining in that narrow band within 100 points to a new high. But we've been here before and we haven't gotten there.
When is the message going to get across to investors? Because I mean, what Chris Waller said really wasn't much different than what we've heard from the other Fed members. It's pretty consistent. Which is, look, we're in a good position. Rates are where they are. Maybe the peak is behind us, but there's no evidence yet that we should be cutting rates anytime soon. And if we do cut rates, it's not going to nearly be as fast and furious.
It's not going to be 6 rate cuts starting March.
At some point, are they going to believe? Like, who do they need to hear it from in order to believe it?
Hope springs eternal. So you continue betting that investors will be looking for that. The dollar, by the way, staging its biggest rally in 10 months. A pretty sizable move for the U.S. currency. And of course, gold moving in inverse with that falling quite a bit as well.
Yeah, absolutely here. It'll be interesting to see, too, once we do actually get to the end of the month and we get that next Fed meeting, whether there is some difference in tone. But as of right now, I'm having a hard time seeing where that's going to come from based on what we heard at the last meeting and all the Fed speak in between.
Well, there's going to be plenty of Fed speak to digest in the days to come.
All right, let's get right to our next guest to help us count down to the closing bell. Brent Schutte joining us, Chief Investment Officer at Northwestern Mutual Wealth Management. And Brent, let's start with the rates picture here. We were talking a little bit earlier about an interesting note out by the folks over at Morgan Stanley, Mike Wilson, kind of saying that for all the hope that we had that we can focus on corporate fundamentals and more idiosyncratic stories, the interest rates are still going to be a big part of the story for the direction of markets writ large.
Yeah, I agree with that. I think what you've seen the last few weeks is that inflation is not dead.
So you saw that in the wage numbers that came out with the jobs report a couple weeks ago that show that wages are stuck in the low 4% on any trend basis that you look at. And so wages are still an issue. And from the inflation standpoint, last year, core CPI on a 3, 6, 9-month basis, as well as a 12-month, is still stuck in the low threes. Service sector inflation ex housing is stuck in the 3 to 4% range. And underlying trend measures of inflation, such as the Cleveland Fed median CPI, after kind of being in a good area, have started to trend back up. And so to me, inflation is still the big question. I don't think inflation is dead. I think we had really good news because inflation was tied to COVID. As we pushed further past that in 2023, I think you saw that unwind. Now I think inflation is the end of the cycle thing, where you have excess wage growth because you're running out of workers to hire. And that is keeping service sector inflation high, core inflation high. And I think you're actually seeing it embedded a bit more in the U.S. economy because in that NFIB also last week, I should mention, compensation plans are still high, pointing to high wage growth, and prices, plans to raise prices is still high, pointing to future inflation. And so all in all, I think it comes back to rates and inflation, which are still, I don't think we're out of the woods yet.
Well, I am curious, too. I mean, we were talking a little bit earlier about the latest New York Fed survey that showed that consumers have actually started to refocus their attention on their existing debt load, basically start paying that down rather than continue to spend. I'm wondering if that becomes a worry here, that if the consumer really is retrenching, that could have a material impact on economic growth.
Absolutely. I think you're wearing off the excess savings. Higher interest rates are starting to bite. And so the consumer, especially at higher levels of consumer incomes, haven't really felt higher rates yet because most of consumer debt is mortgage debt that was fixed. But as those higher rates stay with us for longer, that begins to work its way on the consumer's income statement, especially at those lower income levels. And I think you're going to continue to see the impacts of that as these rates stay high, and that will continue to slow consumer spending in the future.
When it comes to overall this discussion of a rate cut, the market is obsessed with figuring out the timing, and it's going to be a theme all first quarter. We know this, but the reason behind a rate cut is arguably more important. Art Hogan was saying that there are bad rate cuts and good rate cuts. Bad rate cuts, of course, are because the economy goes into a tailspin and the Fed is forced to act. What does a good rate cut look like, Brent?
A good rate cut would be the Federal Reserve starts pulling rates back because inflation is moderating or pulling back towards their 2% target, which I still think is unlikely for March, just given the data that I talked to you about before. Look, I think it's more likely the Fed doesn't cut rates until there is actually job losses, which would then cause, I think, a recession, because once the labor market starts to weaken, you do tend to see it trend fairly quickly. And once the Fed cut rates when the labor market weakens, it's almost always too late. And so to me, that's what a bad rate cut looks like. And that's the one that I think is more likely than not versus a good rate cut, because I just think the pace of inflation, we've done the easy part of inflation coming down has happened and has occurred. I think you're at the stickier part, which is typically the end of a cycle part, which I think is where we're at right now.
You were talking about job losses, but also about wages proving to be pretty sticky. How are the early batch of corporate earnings we've gotten so far contributing to your view of the labor market?
Yeah, I don't know if they've changed it too much. I mean, to me, earnings are what earnings are going to be this quarter. I think it's more about what they're going to be in the future. And even if earnings in the S&P 500 grow by what they're expected, which is around 7 to 8% in the next 12 months, the S&P 500 still trades at 20.5 times those earnings. To me, in an interest rate environment of 4 to 5%, I'm not for sure 20.5% or 20.5 PE makes a ton of sense. And so I think there's just a lot of good news and a lot of hopes, as you mentioned earlier, baked into equity markets right now that I think need to pull back in the shorter term, before we get more interested in equities again.
So then that leaves us, I guess, tilted a little bit more towards fixed income. Does that still offer, on a relative basis, that is, the same risk-reward balance that we saw last year?
Yeah, I mean, 4.5% on the Bloomberg aggregate, that's a pretty decent level of compensation. Even if I think inflation is going to push higher, I think you're eventually going to see a recession, which will cause it obviously to push lower and cause rates to push lower. I guess back to that bad rate cut scenario that we just talked about. And so at these levels on fixed income, I think it obviously compensates you for that inflation risk that's still out there. And I think it gives you a real return above, what I expect inflation to be longer term, which I expect the Fed will get inflation back to 2%. They know how to do so. They've attempted, obviously, to kind of do so in a way that allows for the potential for a soft landing. But if inflation doesn't tick back, and it certainly has stopped, I think so, they will eventually finish the job.
All right, with about 3 minutes to go before the U.S. stock market closes, what within equities looks like it provides pretty decent value?
This is where it's kind of a bit odd because I'm calling for a recession and things like small caps are much more economically sensitive. But to me, the S&P 600, for example, trades at 14 times earnings that aren't expected to grow and is still well off its highs that it set a couple years ago, versus the S&P 500, which, as you mentioned in the opening, is nearer to its all-time high. And so I do think there's parts of the market for people who are patient, for people who are wanting to buy when you might get some pullback in stocks. I think small and mid cap in the U.S. look attractive over the next 1, 3 to 5 years, as well as even value stocks, which have been left behind and certainly don't trade anywhere near what the overall S&P 500 does.
All right, Brent, always great to talk to you. And by the way, I really appreciate you sort of digging through that 2 feet of snow you got up there in Milwaukee and coming into the office, because we got 2 inches here in New York and there's literally nobody in the office today. But
I'm a Wisconsinite now, originally from Illinois, but now I've moved to Wisconsin, so 2 feet of snow is nothing.
All right.
So.
Well, you're still friends with us. Brent Schutte over at Northwestern Mutual Wealth Management, helping us count down to the closing bells. As we are moving closer to those bells with just about 2 minutes to go, our full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting it down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with Carol Massar and Tim Stenovic. Welcome to our audiences across our Bloomberg platforms. That includes television, radio originals, and our partnership with those folks streaming on YouTube. Stocks on the back foot in a big way here right now, Carol, with 10 of the 11 S&P sectors deep in the red.
Yeah, and if you're a member of the KBW Bank Index, you're probably even down more than we are seeing in the major equity averages. That index is down about 1.4%. If you're Morgan Stanley, you're down more than 4%. So we know big bank earnings continued today, and that is certainly one of the underperformers, that area today.
Yeah, we talked to Katie Kaminsky over at Alpha Simplex Group. I know you guys spoke to her a couple of weeks ago, and she mentioned that change in tone that we're seeing and referenced Fed Governor Chris Waller's comments earlier today. And she says, the market is pricing in too many rate cuts this year. She thinks there's going to be 3 or 4, and she's kind of leaning toward 3 rate cuts and says something bad is going to happen if you're going to would have to happen in order to see more rate cuts than that.
Yeah, it's the same old story when it comes to the Fed speak, yet markets seem disappointed each time any kind of Fed official says maybe not 6 rate cuts. What's interesting here, Romaine, is volume has picked up today. It's about at least 10% higher than the 20-day average on a day where it feels like we're just kind of meandering.
Yeah, it'd be interesting. Well, everyone's back at their desk for one, or at least at their desk somewhere, depending if you got snowed in. But it raises the question, too. I mean, we really are headed into the heart of, I guess, what can be called catalysts for the market, whether it's earnings season. Remember, we get some big economic data next week here when it comes to looking at fourth quarter GDP. And then you move in towards the end of the month. And, of course, you get the Fed and that next meeting. We are getting the closing bells here in New York, pretty much red across the screen, no matter where you look. So let's walk through the numbers really quickly here. The Dow Jones Industrial Average lower by about 230 points, down about 0.6%. The S&P is going to close lower by about 18 points, or about 0.4%. And we should point out that it's now testing to the downside one of its key short-term moving averages. The NASDAQ Composite down about 0.2%. We should point out the NASDAQ 100 almost finished the day in the green, but it's going to finish the day unchanged. But the big laggard on the day, you can find that in the mid caps and the small caps. The Russell 2000 RTY down 1.2%.
All right, and definitely more of a negative tone in the trade overall. If I look at the S&P 500, you've got 362 names, Scarlett, to the downside, 137 actually gaining some ground today, 4 unchanged.
All right, let's take a look at the sector performers here. We'll start with the laggards, the ones that are leading the market down overall. You have energy off by 2.4%, with all 23 big cap energy stocks lower. Consumer durable and apparel down 1.8%. Capital goods also losing more than 1%. On the flip side, your outperformers include semiconductor companies, NVIDIA and AMD, as well as telecom names, Verizon, and autos and components up 0.4%.
All right, guys, let's get to some of the individual gainers in the Tuesday trade. And atop the list, in fact, number one in the S&P 500 and the NASDAQ 100 is AMD, Advanced Micro Devices, finishing the day just off its highs, 8.3% to the upside, rallying the highest to its highest, I should say, since November of 2021. So in quite some time, over more than 2 years. Barclays raising its price target on the stock to 200 from 120, seeing AI as a primary driver of growth, saying the growth will be driven by multiple customers across hyperscale and enterprise. Barclays continuing saying, while NVIDIA has a lead in AI, Barclays thinks the desire to have a second source will overwhelm difficulties for the software ecosystem. I thought that was kind of interesting. Barclays has an overweight rating. Susquehanna Financial also raising its target on AMD to 170 from 130. They've got a positive rating. AMD closing just shy of $159 a share. We also, I'm going to stay with chips for a moment because we did have a deal in the chip space. Chip design company Synopsys agreeing to buy software develop Ansys for about $34 billion. It was a cash and stock deal. It's one of the largest deals announced worldwide so far in the past 12 months. So kind of interesting play. Synopsys, I thought, was interesting. It was up more than 3%. The company that it acquired, actually, we saw some selling in that name. Which
I thought that was weird too, right?
Right?
Yeah.
I don't know. Maybe they just, I don't know. Maybe they didn't think they didn't pay enough. I don't know.
Yeah.
Anyway. All right. Getting away from the chip space, if I may, JetBlue, an outperformer at its highs today, guys, almost a 12% gain, finishing with about a 5% gain. We know what it's about. Basically, JetBlue getting a dose of, hey, investors, tell me how you really feel about my plans to buy Spirit Airlines. Basically, a federal judge in Boston blocking JetBlue's
Is there anyone who liked that deal? Because apparently the judge hates the deal. Regulators hate the deal.
Yeah, the
investors hate the deal.
investors.
And the CEO who brokered that deal is on his way out.
Yeah.
So.
He liked it.
Yeah. It's always kind of wild.
A weird cultural fit between those two companies. I don't know if they would have. Yeah, they would have clashed. Hey, speaking of that, my top decliner, Spirit Airlines, down 47%, finishing the day at $7.92. It fell as much as 1.61%, the biggest intraday decline on record. This after that federal judge blocked JetBlue's acquisition of the company, saying that the combination would stifle competition and raise fares for consumers. And speaking of air travel, let's check in on shares of Boeing, the worst performer on a percentage basis today in the S&P 500, down 7.9%, sinking yet again after falling more than 12% just last week. Shares extending their sell-off so far this year after we heard from Ryanair Holdings CEO Michael O'Leary, one of the biggest customers for the 737 MAX, who said that there's a risk that there will be further delivery delays that Boeing management will get distracted in Seattle, or there will be new processes or something. This Michael O'Leary said in an interview regarding the 737 MAX 9 that is continuing to be grounded. Down 23% so far this year.
I know, that's pretty remarkable.
It's remarkable. I mean, lost nearly a quarter of its value just in half a month. And then shares of Apple, the worst performer on a points basis in the S&P 500 today. Apple shares fell after the Supreme Court here in the U.S. refused to consider Apple's appeal in an antitrust suit challenging its App Store. We've been covering this one for years, guys. It's a decision that will likely affect billions of dollars in revenue for Apple. In-app spending is forecast to reach $182 billion this year and $207 billion in 2025. And if Apple can't continue to get that 30% cut, if there are other app stores that where this stuff becomes where consumers can get this stuff, then Apple could take a hit.
And I'll just add another one there, which point out Morgan Stanley did end the day down at 4% here. Worst day for that company going back over the last 3 months. And in fact, you go back 3 months ago, the last worst day that they had was actually on an earnings day as well, back in October, mid-October, when those shares dropped about 7% on the back of earnings. Let's check in on what happened in the yield space here, because we did see significant activity there as people resumed the sell-off in the bond market. And of course, that was directly tied to some of the comments that we heard out of Christopher Waller. The idea here that if you're betting on a drop in rates, don't expect to get that anytime soon. He's saying the Fed funds rate should stay elevated, and you see that reflected in the price action in the spot market with your 10-year yield up 13 basis points here, your shorter-term 2-year yield up by about 8 basis points on the day. The entire curve, guys, shifting higher.
Yeah, the entire curve shifting higher. The U.S. dollar also shifting higher as well. Stronger by a wide margin. The biggest rally in about 10 months on Chris Waller's comments. It raises all kinds of issues about how other central banks around the world start to move next as well.
I got to tell you, I'm a little surprised we didn't see more of an equity market reaction to the Fed governor's comments here. I mean, if you go back to the beginning of the year, we're pretty much flat on the S&P 500. And that was when rate expectations investors were so much more confident that there would be, 5-6 rate cuts this year. And since then, we've just heard so much pushback, but we haven't seen equity markets match what we've seen in the bond market.
I think what's interesting, too, is I think the equity markets are trying to figure it out. Okay, wait, so if the Fed doesn't need to be as aggressive with rate cuts, maybe that means the economy is actually doing okay and can kind of get through that, soft landing, kind of Goldilocks scenario. But at the same time, doesn't want them to stay too high, right? Because you bring it down a little bit and then more of a risk risk trade can be on. People are willing to take some risks, if you will. So I think there's kind of this tug within the markets right now.
Well, yeah, and I would
certainly on the equity side.
Yeah, absolutely. And we talk about a market that was pretty confident they were going to get basically the equivalent of about 6 rate cuts prior to those Waller comments. They did pare back those bets, but they're still pricing in a much higher probability here that we'll still get about 5 to 6 rate cuts. So, I mean, we basically go from a firm 6 to kind of 5 to 6. Yeah. So I guess expectations did temper here. But just to address your point, Tim, too, I think you have to see a little bit more movement in those yields for it to really start to rattle equity investors.
And I should say that I was talking the S&P 500, not what's happening with the Russell 2000, because that's certainly been a different story, Scarlett.
What'll be interesting is what happens at the FOMC meeting at the end of this month, because Fed officials are likely to start talking about slowing, not ending quantitative tightening, which would have the effect of providing some easing to the overall economy as well. And not to say that they're going to do anything on it right away, but just that discussion will start leading people to place their bets.
Yeah, and one other thing I would say on the equity side of things, I know we have to wrap, but the other, we've had quite a run up, and we've seen, 52-week highs taken out in a lot of different sectors and individual names. And I think for an equity investor, you kind of got to be like, okay, is all the good news and the expectations factored in, or will earnings ultimately show us that there's more room to run? So I think it's just this kind of tug of war, pull, I guess, or something like that.
Wait and see.
I don't know. Yeah, wait and see. All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, guys. It's Tuesday. We're done. We'll see you again tomorrow for Beyond the Bell at 4 p.m. Wall Street time.
A lot more coverage coming up here on Bloomberg Television. Despite some of the optimism over rate cuts, there are still some significant risk out there for the year ahead. We're going to discuss what maybe is keeping investors up at night, or maybe what should be keeping them up at night over the course of the year. That conversation coming up after the break. This is The Close on Bloomberg. Here on the first day of a holiday-shortened 4-day trading weekend, stocks started off on the back foot. All the major indices moving lower here on the day, about 0.4% for the S&P 500, the Russell 2000. Those small caps, as well as some of those mid-cap names, those were the big laggards here. The Russell down 1% on the day, and remember, that was dragged down primarily by the large weighting that you have in there of a lot of those small-cap energy names and some of those regional banking names. But we did see a sell-off once again resume in the Treasury space, and that was on the back of those comments by Fed Governor Chris Waller, making it clear here that any expectations for multiple rate hikes this year might be way too premature. We saw the entire yield curve shift up. The 2-year yield only went up by about 8 basis points. Most of the activity was on the longer end of the curve, with the 10, 20, and 30-year yields up more than 10 basis points here. And the strength that we saw in the dollar complicating things for a lot of investors who were out there searching for value. As for some of the other pockets of the market, a mixed day here when it comes to the crypto space. Bitcoin did move higher, but some of those ETFs, in fact, almost all of those ETFs moved lower here on the third full trading day that they've been in business. iBit, which of course is the iShares ETF, down 1% on the day. And keep an eye on the bank stocks here. We're going to get Discover Financial a little bit later in the week, but Morgan Stanley was the big laggard today, down about 4%, the worst showing it's had in about 3 months. Some concerns here about the trajectory of that business, some concerns as well about the trajectory of rates. You go back to one of the big bright spots today, and that was the Philadelphia Semiconductor Index. A lot of the names in that index did manage to post pretty sizable rallies, and that was largely due to AI. The continued momentum that effectively started more than a year ago continues to persist here in 2024. You can see the outperformance here of what else? NVIDIA. That, of course, is the main AI stock, the main proxy, I should say, for AI. But that is starting to broaden out, Scarlett. We've heard from a lot of folks on this show here that there are a lot of other names here that stand to benefit other than NVIDIA. The big question is, will investors seek them out?
For now, they're sticking with NVIDIA, but we've certainly seen that in the share prices. Let's broaden our conversation here, because global leaders are gathered in Davos, Switzerland this week, and many are feeling optimistic about the year ahead. Here's what the head of the International Monetary Fund is saying.
23 comes better than we expected by a small margin. There is some wind coming from 23 into 24.
However, for the worrywarts out there, Bloomberg Economics has laid out a list of risks to be mindful of in 2024. Tom Orlik, Bloomberg Economics chief economist, joins us now. And Tom, the big theme that kind of combines a lot of the risks out there is rising geopolitical tensions, whether it's in the Middle East, in Ukraine, or in China. And as a byproduct of that, how different countries react and respond to all of that. Walk us through what you see as the biggest geopolitical risk.
So first of all, Scarlett, I've just got to pick you up on one of your earlier comments. You said global leaders are gathering in Davos, but I see you and Remain here in the United States, so they're missing a few.
This is why we love that.
Yes.
Flattering.
So as you noted, 2024 is starting a little bit better than I think many people would have expected a few months ago. But what we've done in this big take today is pull together a list of all the things that could potentially go wrong. And of course, as you say, geopolitics is near the top there. Think about the Houthi attacks on shipping in the Red Sea and the UK-US response with bombing of Yemen. It's easy to see how an expanding war in the Middle East could start to hit shipping costs, start to hit oil prices, take a chunk out of growth, add an additional impetus to global inflation, and mean that Fed pivot is delayed longer than the markets expect. You also mentioned AI. Of course, AI stocks like Nvidia are market darlings right now, but where are their crucial suppliers? All of the big AI companies depend on chips made by TSMC, that unique company on that small island off the coast of mainland China. And as we were reminded by the election over the weekend, Taiwan Strait, well, that's not a place which is free from tensions. So a lot of risks out there.
Absolutely. And the other thing, of course, is when you talk about mainland China, the economy is not doing as well as many people would have thought, given that it has come out of COVID-0. And in fact, we heard from the premier that the economy grew about 5.2% last year. Does a slower growing China raise more risks of any kind of action against Taiwan?
So that's a really interesting question, Scarlett. We heard China's premier saying he expected growth, I think, of around 5.2% in 2023. Now, on its face, that's a pretty good number. But remember, it's also a head fake. China's growth in 2022 was depressed by COVID lockdowns. So growth in 2023 benefited from that low base for comparison. Heading into 2024, most of the arrows on China's growth are unfortunately pointing downwards, dragged down by that real estate crisis. We think this year China will grow considerably less than 5%. What's the dynamic between China's economy and China's geopolitical ambitions? Well, my sense is that with the economy in a pretty tough spot and with some serious challenges with unemployment for young people, China's leaders are going to have a bunch to keep them occupied at home.
Yeah, I think it's interesting. I mean, this whole article that you and your team put out, it's labeled, sort of the pessimist guide here. I'm wondering if there are any sort of optimistic notes maybe that investors can gravitate to. And I know one that your team has flagged and some of our guests have flagged is they are seeing a little bit more of an encouraging backdrop for emerging markets, given the drop in rates that we've seen, at least in benchmark central bank rates.
Yeah, I think that's a great point, Remain. So the last few years have been characterized by tail risks becoming realities, right? From Brexit to US-China trade war to a global pandemic. These events which investors put a low probability on suddenly materialized. So I think one of the upside risks for 2024 would be if the risks that we identify in this note, from Houthi rebels to stress in the Taiwan Strait, just not materializing. Beyond that, I think, as you say, Remain, there's reason to be optimistic about the outlook for a number of emerging markets. And I'd flag two significant tailwinds. The first is that many emerging markets have got inflation under control, and that means their central banks are now cutting interest rates, giving a boost to growth. The second is that geopolitical headwinds for countries like China are actually tailwinds for some smaller emerging markets as manufacturers follow a nearshoring or a friendshoring strategy, driving more investment and more exports from places like Poland, places like Mexico.
What about Peru?
Peru is also on that list. Peru has a bunch of free trade deals with some of its big neighbors. Peru is also on the downslope in terms of interest rates, so it's also one of those countries that pops up on that list. Of course, Peru also faces some significant domestic political challenges, so a mix of positives and negatives there.
All right, Tom, always great to catch up with you. Tom Orlik helps lead our Bloomberg economics coverage, out with the Pessimist Guide to Global Economic Risks in 2024. A great read here on the Bloomberg terminal and wherever you get your fine Bloomberg products. Coming up here, we're going to talk about JetBlue, we're going to talk about Spirit, and we're going to talk about the merger that may never happen. A federal judge blocking the deal. The big question going forward is the new incoming CEO of JetBlue going to be willing to fight this fight? That conversation coming up after the break. This is Bloomberg.
This week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As markets anticipate a dovish pivot by central banks, policymakers grapple with two wars on the global stage, and AI continues to dominate the tech headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Continuing coverage this week, only on Bloomberg Television and Radio.
All right, Spirit having a record drop in its shares today, down about 40%. This after a federal judge here in the U.S. blocked JetBlue's $3.8 billion bid to buy the discount airline. A lot of questions about where JetBlue goes forward with this, and Spirit for that matter as well. Helene Becker joining us right now, senior research analyst over at TD Cowen. All right, let's get right to it here. I mean, this is the second time that JetBlue has kind of had its hand forced for a merger that it was trying to complete. Not quite clear if they're going to really try to see this through here, but we should point out that the man who orchestrated this deal is stepping down. They have a new CEO, and the big question I have is whether she's going to have an appetite to really fight this out in the way that maybe Robin Hayes would have thought.
Hi, Romaine. No, I don't think she will. I don't think there's an appetite to move forward. And the primary reason is I think they'll be able to get a lot of the Spirit assets in bankruptcy when we think Spirit will have to file. And we think the assets will be made available then.
This raises the question as to sort of what sort of drove the announcement of this merger to begin with. There was a lot of discussion at the time that this had more to do with the orders that Spirit had on its book for a new aircraft, and that this was sort of a more efficient way, if you will, for JetBlue to get their hands on that aircraft.
Yeah, exactly so, Romaine. So by buying Spirit, JetBlue would be able to grow not organically, which takes a very long time and costs billions of dollars. Spirit had, a lot of aircraft. I think it was 215 aircraft that they had, or have, not past tense yet. And JetBlue, if they were to go out and buy 200 aircraft or 150 aircraft, it would cost upwards of $5 billion. So looking at Spirit at the time, they thought they'd be able to accomplish that goal and have aircraft coming into the network for the second half of this decade, be able to grow, offer more flights to more nations. And in the end, that's just not what the DOJ or the judge saw in the case.
For JetBlue, how does it move forward when it comes to growing its operations? Because the DOJ basically would not allow it to move forward with American Airlines, that partnership, and now it can't acquire Spirit. What is its next move? What's left in its bag of tricks?
Yeah, so I think what will happen is the judge in the NEA case, the American Airlines case, said that they should look at the way Alaska Air and American Airlines structured their alliance. And that alliance was structured in a way that received regulatory approval with no issue. So I think if they were to restructure the alliance with American, it would have to look like the West Coast Alliance. So that's one alternative. The other alternative is to sit down and figure out what they want to be in the next decade, where they want to grow, talk to the lessors, because we've had 4 or 5 years of excessive growth coming out of the pandemic, but that's slowing. And we're seeing not only here in the U.S. stress on airline companies, but we're seeing it elsewhere in the world. And we think that even with the supply chain issues, with the Boeing MAX issues, that there are Airbus aircraft that will be available. And as part of its restructuring, I think Spirit has to reconsider whether it needs all those aircraft, how they want to address going forward. We recently put out a note an hour or so ago in which we said we didn't think there was a way forward for Spirit. And we think that lessors, rather than renegotiate leases, would take the aircraft away and put them in carriers. And there's no guarantee that 200 aircraft are staying in the United States. Some of those aircraft.
So, Helene, for Joanna Garrity, the new CEO of JetBlue, once Robin Hayes formally steps down, what is the one thing that investors want to see her do following these defeats at the hands of the DOJ?
Yeah, I think they really want to see her step up to the plate, be decisive, announce a strategic plan, get that worked out between now and they'll report earnings on Tuesday, January 30th. So I think they'll have a lot of questions. The team will get a lot of questions on steps forward. What do they do? Do they place aircraft orders? And I think she needs to be very assertive and very decisive about the things they say. And it wouldn't overpromise or underpromise and overdeliver.
Of course. Helene Becker, really appreciate your joining us today. Helene Becker of TD Cowen, giving us some insight here on the JetBlue Spirit Airlines merger that's not going to happen. Andy Blocker will be joining us next to talk about the political scene in the U.S. Andy Blocker from Invesco. This is The Close on Bloomberg.
A down day to start a new week in U.S. equity markets. The S&P moving lower by about 0.4%. The big laggard on the day, you could find that in the small cap space, with the Russell 2000 lower by more than 1%. A lot of this had to do with the big move higher that we saw in yields, the big move higher that we saw in the dollar on this day. That was largely on the back of comments coming out of Fed Governor Chris Waller, making it clear here that some of the speculation about multiple rate cuts by the Fed this year might be a little bit too extreme, at least for now. You did have a few bright spots here in the market. You could find that in the Philadelphia Semiconductor Index, up about 1% on the day, led largely by a 7% gain that we saw in AMD. But the rest of the space here, a mixed bag here. We saw the drop in crude and a lot of concerns about weakening economic conditions, and a lot of concerns and a lot of attention right now about geopolitics, the big election over the weekend in Taiwan. And of course, Scarlett, we have a big election, I'm told, at some point this year here in the United States.
That's right, Romaine. Well, in advance of that, Donald Trump has been tightening his grip on the GOP nomination. He had a huge win in last night's Iowa caucus. But as election season rolls on, there is still a lot of concern around ensuring U.S. election integrity. Microsoft CEO Satya Nadella spoke about the challenges ahead. Take a listen.
Disinformation or misinformation and election interference is going to be a real challenge that we all have to tackle. We as a company have to do our best work, right? Whether in the context of AI, we have lots of initiatives around content IDs and other things that will then help us, at least vouch for the veracity of any content out there. And that's, I think, the work that we need to do. But ultimately, in the democratic process, essentially ensuring the integrity of elections is one of the fundamental challenges we have to face up to.
For more, let's bring in Bloomberg's Dan Flatley in D.C. Dan, thank you so much for joining us. Iowa turned out to be not so dramatic after all. It was pretty incredible in that different news organizations called the contest for the former president much sooner than expected, when some caucus sites had not even begun voting. Is this the template for what we're going to see in New Hampshire and the other states?
Well, certainly the former president is polling higher than his other two competitors in those races, Nikki Haley and Ron DeSantis. What we're trying to understand at this point is what the dynamic between Haley and DeSantis is going to look like going forward. Haley is expected to do better than she did in Iowa and New Hampshire, and potentially best Ron DeSantis there. Does that give her enough momentum to take on the front runner, or does that is it sort of the beginning of the end for her candidacy and for potentially Ron DeSantis's? So certainly no real surprises out of Iowa, but we know that former President Donald Trump came out of that with the 51% that he was really looking to get to show that he has a stranglehold on the nomination at this point.
I was a little surprised, if you will, Dan, by just how wide that margin was. And I know the polling kind of suggested this, but when we start talking about a viable contender for the nomination here, I can't recall a time where we've had that much of a differential, 30 percentage points from the front runner to the second runner. And I'm supposed to believe that there's a catch-up?
Yeah, I think it's very hard to believe at this point, although there is still a lot of tape to play out here before the end of the primary season, obviously, and then the general election in November. Although I was sort of thinking about the Democratic primary in 2020 and how there was a wide field of candidates, and the current president, Joe Biden, was trailing in some of the early states and then ended up making up some of that ground later on. I don't know that we'll see a similar dynamic here just because that margin is so wide, to your point, Romaine.
So given how wide the margin is, how do you anticipate this will influence funding for DeSantis' campaign or Nikki Haley's campaign?
Well, it sort of depends on who the donor base looks at as the most likely candidate to get closest to that percentage where they could take on Trump. Is that Haley? If it's Haley, then you're going to see a lot of pressure on Ron DeSantis to drop out of the race, throw his support behind her, and vice versa. Whether that actually happens or not is kind of between the two candidates. And right now, they are not thinking in those terms. They're thinking about surviving to get to the next state, to get to the next contest, and to try to make it to the end, at least to the point where it's, the outcome is more obvious than it is now.
All right, Dan Flatley out in D.C., a closer look here at some of the results that we got coming out of the Iowa caucus as we now turn our attention to New Hampshire and beyond as the presidential primary season heats up. A lot of questions here, not only about who could potentially win, but why. Andy Blocker joining us right now, Global Head of Public Policy and Head of U.S. Government Affairs over at Invesco. And I want to start off with just kind of the margin of difference, Andy, because I was going back to look at the previous caucuses. And I know 2020 was a little bit different for Trump because he was the incumbent, so he didn't really have the challengers that he has now. But you go back to 2016. He lost the Iowa caucuses to Ted Cruz. You go back to New Hampshire. He did win New Hampshire, but not by the 30 percentage point margin that he won in the most recent campaign in Iowa here. This seems like, at least in the here and now, and I know it's just Iowa, that the voters have made it clear who they want to be their Republican nominee for president. Why am I to believe that something's going to change materially as we get through the other states?
Well, let me back up what you said first, Romaine, which is, yes, they have made it very clear, and they've made it very clear ever since Donald Trump started getting indicted. And before he started getting indicted, DeSantis was very, very strong, and you could see a switch flip once he got indicted. People rallied around Trump, says, you're not going after our guy, we're going to rally behind you. And I think that's been a lot of energy for that. They feel like that's the fix is in against him. So that's part of his strength, and he's really carried that to this moment. But with New Hampshire, as we know, it historically doesn't like to do what Iowa does, and that is Nikki Haley's chance. So as they say from one of my favorite movies, Dumb and Dumber, so you're saying there's a chance. And I sort of am.
Yeah.
But we'll have to see.
What gives her that chance? I mean, I know on paper and by all sensible measures, she would seem to be a better candidate for a wide variety of reasons that we don't have to get into. But as we know, we're not necessarily living in sensible and sane times anymore. What's the value proposition for her pitch to voters as to why they should somehow not back Trump, and for that matter, DeSantis either, and back her?
So I think the number one thing for Nikki Haley is she's really going after the anti-Trump wing of the party, which Chris Christie owned for the most part, and you saw he's gotten out now, so she should probably get a lot of the Chris Christie vote. You have a different electorate in New Hampshire, much more independent-minded Republicans, and there's a big movement we've heard from Nikki Haley's camp to get out independents to vote on her behalf. So there is a potential coalition that could come together in New Hampshire to either get her a victory or get her close, which would lead up to South Carolina down the line.
Yeah, creating that necessary momentum heading into South Carolina, which of course she's expected to do well in because she is the former governor. Having said that, that's the Republican side. For President Biden, he has begun his campaign. What is his message to voters? Because as much as the Republican nominees who are not named Donald Trump try to avoid talking about Donald Trump, he is very much, President Biden, zeroing in on Donald Trump.
That's right. I mean, you can see from his polling from last year, historic lows. So that's not good. So really, he's got 3 Ds. And all of those Ds are to make it not about him. First D is Donald Trump. Make it about Donald Trump, not a referendum on himself. Number 2, it's about democracy, establishing and maintaining democracy. He needs to show that Donald Trump is a threat to democracy. And third, Dobbs. Interestingly enough, we saw a week and a half ago, Donald Trump basically give the Biden campaign red meat ammunition when he said and declared, I terminated Roe v. Wade with Dobbs' decision by putting those people on the Supreme Court. He basically took credit for that. And we've seen those elections with respect to Dobbs have really been in favor of the Democrats. So those are the 3 issues: Donald, democracy, Dobbs.
Do those 3 Ds help Democrats in the Senate elections and the House of Representative elections?
I think potentially the democracy and the Dobbs can. The Donald cuts both ways, especially for those in the House. We saw in 2020 that even though President Biden won and defeated Donald Trump in 2020, because Donald Trump got all his voters out who voted for him, they also voted for the Republican candidates in Congress. So you could see standard Republicans plus Trump Republicans voting for those in Congress on the Republican side and help them. So that's a really tight race. We think the numbers currently favor the Democrats, but we have to let them vote.
Andy, we only have about a minute left. I am curious, is there appetite, and more importantly, is there viability for a third-party candidate, whether they're on the right or the left side of the spectrum?
Well, Romaine, there definitely is an appetite. I mean, you see on both sides, Democrats don't want Biden, and Republicans, for the most part, don't want Trump. But if they're they're the nominees, they're going to have a choice. But we think that the viability is the question. So, yes, no labels probably in April will have another candidate. But the question is, can they get 10%? Can they get 20%? That's the question.
All right, well said. Andy Blocker, really appreciate your joining us. Andy Blocker of Invesco on what we can anticipate in 2024. Coming up, what we can anticipate for the rest of this week. We know the big banks have all reported their results. We'll get insight on what we've learned from Dick Beauvais, Odeon Capital Group financial strategist, and what the regional banks are likely to say. This is The Close on Bloomberg. Goldman Sachs and Morgan Stanley reported results this morning and rounding out the last of the big U.S. banks. Next up are the regionals. Here now to help us walk us through what we've learned is Bloomberg finance reporter Catherine Doherty. Catherine, thanks so much for joining us. What were the big takeaways you thought from the fourth quarter, and what does it tell us about the state of U.S. banking, the health of U.S. banking right now?
So this morning with Goldman and Morgan Stanley both reporting, you're seeing how their share prices are reacting. That is the tale of 2 different stories and different results. Goldman has been touting 2023 as their transition year, as they're exiting businesses that they realized were not profitable for them, their consumer business. And as they were talking through how they're transitioning out and away from these costly initiatives, I think that that's why you're seeing the positive reaction from investors. On the opposite side, Morgan Stanley, we had the new CEO make his debut. They were talking a lot about their crown jewel, the wealth management business, and how their margins are likely to stay lower than anticipated, and also sales and trading was lower than expected. So that could be a big reason for the negative reaction that you're seeing in their stocks, and the reason that each of those banks is performing in different ways.
And each bank is kind of at a different sort of point, I guess, in its history. Obviously, with Morgan Stanley, you're talking about a new CEO at some point is going to be taking the helm this year. And with Goldman, a CEO who's been around for a while, though I think there's some people that maybe don't want him around. But he had a chance to kind of give a victory lap, saying that a lot of the changes that he had been making over the last year or so, at least in his words, paid off.
They're working through it.
Yeah.
I think that they're showing that the losses and some of the write-downs that they were having to take earlier in the year are making their way through. So that's always a positive momentum when you think about the future.
Yeah.
And then to go to another bank, Citi, they had to talk a lot about their restructuring and the charges that they're going to take that amount to, I believe it's $1 billion in the coming year. But investors I think are happy to hear that they have those plans and actions in place so that eventually the profits will start to shine through.
So there's some specific idiosyncratic things unique to each of those banks. What will you be looking for as the regional banks start reporting their results? What's the carryover?
Deposits and also expense management. We're not expected to see deposit outflows, especially like the period that we saw post Silicon Valley Bank and in the March period of last year. However, deposit pricing is still an issue. When interest rates are remaining high, this is costly for the banks to try and hold on to their customers' deposits, and they're going to have to pay up to make sure that they don't see more outflow. So we're expected to see more of the same, similar that to third quarter. But if that goes up probably more than analysts expected in terms of the costs that it takes to keep those deposits, that's not going to be a good sign. And credit deterioration as well. We're going to be looking for signs that consumers are having trouble with borrowing or spending and paying down some of their loans.
All right, Catherine Doherty, a closer look here at some of the numbers that we got out of those big banks and a look ahead to some of the mid-sized and smaller banks that are expected to start reporting as soon as tomorrow. We do want to continue in the large cap space for right now and have a conversation with Dick Beauvais. He's Odeon Capital Group's financial strategist. Joining us right now. And Dick, before we get to some of the numbers we got today and maybe some of the numbers that we're going to get over the next few days, I do want to go back to last week in Bank of America and the results we got out of them. Just last month, you upgraded that stock to buy after having a hold rating on it for most of 2023. I'm looking at a note that just hit my inbox a few hours ago. Today, you're now downgrading that stock back to hold. Why?
Well, the reason that it was upgraded in the first place was because interest rates were coming down, or it appeared that they were going to come down. And basically, as interest rates come down, the real book value of a bank goes up, and therefore the stocks had lagged the change in the real book value. So we decided to make a buy recommendation on this one and a few others. When the earnings came out, I just came back to the reality that the financial system has changed dramatically in the United States, and Bank of America is simply not keeping up. In other words, if you take a look at the deposit growth of Bank of America, it does not keep up with the money supply growth. If you take a look at the loan growth at Bank of America, it does not keep up with loans overall in the financial system. If you take a look at the growth in the wealth of American households, Bank of America's asset management does not keep up. Then, of course, you've got the structural change that was put in place when they increased the cost of deposits to stop the disintermediation. And what that did is it put in a problem for the bank, because you can't turn around on a dime and then start lowering those deposit costs because they're two-year CDs. So the net effect is you built in a net interest margin problem. Then if you take a look at their loan losses, they're just spiraling upwards. And they're spiraling upwards because credit cards are doing so badly in terms of loan losses, and other areas are doing badly. So it just wasn't there. This company is not going to make more money than they made in the fourth quarter in any quarter till maybe till 2026.
All right, I hear you on that. I also listened to some of those issues that are going on with Bank of America, and I think, aren't these some of the same issues that particularly the consumer-facing banks overall are facing, particularly the super regionals as well as the regional banks? Should we expect to hear some of the same when it comes to deposit costs and the sort of the weak loan growth, or is this a separate story from Bank of America?
No, it's not separate at all. It's very much consistent with what's happening in the banking industry. You're going to see it in one bank after the other as they report earnings over the next 10 days, or certainly over the next 3 or 4 days. Basically the banks were hit with disintermediation. They had to increase their interest rates. When they stop it, when they increase their interest rates, they didn't increase it on demand accounts where the money flips over very quickly. You had to get that money back in by going out a year, 2 years, maybe 2.5 years, and therefore they're now stuck with the fact that they increased those rates. At the same time, most banks, certainly the regionals, have a sizable amount of fixed rate securities that they own, and fixed rate mortgages and fixed rate auto loans.
Right.
So you can't increase the yield on the loan side, whereas you've already stuck yourself by increasing the cost of deposits on the other side.
Right, so they're stuck between a rock and a hard place. I guess the question, Dick, and Catherine kind of referenced this, is the comparison to what happened in March 2023 is kind of inevitable. Do you see any potential Silicon Valley banks or First Republic in the batch of regional banks that will be reporting?
No, I think that the financial structure of the banking industry right now, forced by the regulators, is extraordinarily good. I mean, you have a high degree of liquidity in these banks in the form of cash, of treasuries, of other, federal funds. So basically, they're not at risk of failure. The fundamental problem is that they can't compete, right? In other words, if you're in an industry and you can't compete because you're the high-cost producer, because you've got tremendous amount of regulations, and you're operating against companies which are not being regulated, that are not having the same type of, if you will, structural issues, then you can't compete. And if you can't compete, you can't make a lot of money, and you can't, if you will, increase your share of market at all.
Right.
That's the issue.
If you can't compete, when do you see M&A starting to pick up then, or starting to really kick off for these smaller banks that can't compete?
Well, I mean, essentially, I think if the Federal Reserve would let it happen, it would be happening right now. I think you would see that occurring. But what's the point of buying small banks? Who wants to buy them? In other words, if you're really looking at what's going on in the banking industry, you have to focus on Citigroup, because Citigroup understands that this can't compete issue exists. And so what Citigroup is doing is moving into areas where it can compete. It's moving into business services. It's moving into capital markets, investment banking, and therefore, if you're a bank, like PNC today, if you're a bank and you're going to go out and go buy a whole bunch of smaller banks, you're simply intensifying the problem. What you have to do is make use of your holding company structure and move to other areas, finance, private equity, a series of non-interest income businesses where you don't have the regulatory problem that doesn't allow you to compete. You have to move you've got to move the structure of your business. And as I say, Citigroup is doing that. Buying other small banks would be totally ridiculous.
All right, I'm going to have to leave it there. Dick, always great to get your insights. Dick Beauvais over at Odeon Capital. A look at the big bank earnings that we've just gotten. Quite a few earnings on deck over the next few days, including from Citizens, U.S. Bancorp, Schwab, as well as some of the credit card companies like Discover. Stick with us. We're going to set you up for what markets will have their eye on over the next 24 hours. This is The Close on Bloomberg. A push ahead to some of the big market moving events over the next 24 hours, and we start overseas.
Yeah, there's a data dump out of China, whether it's GDP, retail sales, or industrial production, and of course, Eurozone CPI as well.
Meanwhile, back here in the U.S., we're going to get some big economic data, the Fed Beige Book, as well as what I'm interested in, those retail sales numbers.
Especially for the month of December with the holiday shopping season wrapping up.
And we got a lot more earnings, too. We mentioned a couple of the financial companies, including Schwab and Citizens.
And not to mention U.S. Bancorp and Discover. Discover, of course, a big read on consumer use of credit.
And don't worry, we're going back out to the Bloomberg house out there in Davos, Switzerland. Going to have a special guest, Christine Lagarde of the ECB, scheduled to sit down in that big fluffy chair.
Looking forward to it.
Thanks for watching us. We'll be back tomorrow. This is Bloomberg.